A very good evening, ladies and gentlemen, and a very warm welcome to each one of you to the third edition of Nucleus Software presents CNBC-TV18 Banking Transformation Summit. Over the last 3 years, this platform has brought together India's top policymakers, bankers, and NBFC leaders and Fintech innovators to deliberate on the key developments that are changing and reshaping our financial ecosystem. Each edition has been about looking ahead and about how to anticipate the opportunities and navigate the challenges that lie ahead. This year, our theme is both timely and very ambitious: banking that builds Bharat, AI-powered and credit-driven. We are at a turning point. Artificial intelligence, automation, and digital public infrastructure are changing the way banks are operating today, the way credit is being delivered, and the way trust is built in the financial services landscape, and how we are truly inclusive of every participant. The inclusion conversation has never been more urgent. As Bharat aspires for higher growth, banking must go through a change, higher growth, and go beyond those urban strongholds and must serve the next billion. Today, through a series of keynotes, panel discussions, fireside chats, and engaging conversations, we will explore how banks, NBFCs, fintech companies, and policymakers can come together to build an intelligent, future-ready, and inclusive financial architecture for India. We are honored to have with us distinguished leaders who are coming from across the financial sector, and we look forward to rich discussions that will not just reflect where Indian banking is today, but more importantly, where it needs to go now next, what the next decade is going to look like. And to open tonight's summit, it's only fitting that we hear from the organization that has played a very crucial role in shaping this platform. As a pioneer in banking technology, Nucleus Software has championed innovation, transformation, and future-ready solutions for the financial sector. I'd like to invite someone who has driven transformational leadership at Nucleus Software. Ladies and gentlemen, please welcome on stage Parag Bhise, CEO and Executive Director, Nucleus Software, to deliver the opening address.
Thank you so much, Mugdha. Good evening, everyone. It is an absolute honor to welcome you all, respected policymakers, regulators, industry pioneers, and fellow visionaries, to Session 3 of the CNBC-TV18 Banking Transformation Summit, proudly presented by Nucleus Software. Tonight, we are not just hosting a summit, we are continuing a mission to transform banking into a powerful force of financial services that not only supports but actively builds Bharat's future. Let me begin with a quick recap at how we have done so far. In Season 1, we explored how India's financial sector could support the nation's ambition of becoming a $5 trillion economy. We spotlighted the rise of digital platform, Aadhaar integration, and real-time payments, concepts that at that time were emerging. Fast forward to today, and that vision has become a reality. UPI now accounts for over 84% of India's retail digital payments. India contributes nearly 48.5% of global real-time payments, making us a global benchmark in digital banking. That's the legacy of Season 1, ideas that spark systemic change. Then came Season 2, titled Bharat's Ascent, Roadmap for Amrit Kal. We shifted our lens from growth to inclusion, from infrastructure to impact. We asked, how can innovation empower not just metros, but the heartlands of India? And the results speak for themselves. In August 2025, UPI hit a historic high, 2001 crore transactions worth rupees 24.85 lakh crore. That's over 7,500 transactions per second, powered by over 500 million active users, many of them from rural and semi-urban India. The digital adoption across Bharat is not just growth, it's transformation. And now, we arrive at season 3. Our theme this year, Banking That Builds Bharat, AI-powered, credit-driven, is a call to action. Because Bharat today needs more than access, it needs empowerment, it needs credit that is intelligent, inclusive, and accessible at scale. And that's where AI becomes the game changer. AI allows us to assess risk where data is thin, to approve credit where paperwork is missing, and to understand customer intent where history is limited. According to the RBI's recent papers, AI-led underwriting is already improving decision accuracy, reducing NPAs and expanding credit into previously underserved sectors, especially MSMEs and informal borrowers. And that isn't just about speed, it's about scalability with responsibility. Guiding this transformation are the RBI's free AI 7 sutras, principles that ensure that AI is fair, responsible, explainable, ethical, accountable, inclusive, and transparent. These sutras provide the framework for scaling AI-driven credit responsibly, ensuring innovation empowers every Indian while safeguarding trust and stability. At Nucleus Software, we are proud to be part of this revolution. We are powering AI-driven lending platforms, enabling real-time credit decisions, and helping banks expand reach with agility and trust. But let's be clear, technology is just one part of the puzzle. To truly build Bharat, we need a threefold alliance. Banks and NBFCs as the engines of delivery, technology partners as the enablers of innovation, and regulators as the guardians of stability and trust. Together, this triad forms the foundation of a financial ecosystem that is not only resilient but relevant to every Indian. And in this context, it is a privilege that we will shortly hear from Sri M. Rajeshwar Rao, Deputy Governor of the Reserve Bank of India. We'll be keen to hear his perspective on how regulation is evolving to support digital innovation, AI-driven credit models, and financial inclusion. That will be invaluable as we chart the next phase of India's banking journey. Thank you for your most valuable presence here, sir. Later in the program, we'll also engage in a fireside chat with Sri M. Nagaraju, Secretary, Financial Services, Ministry of Finance, on how the government is steering digital public infrastructure, AI and governance, and next-level credit enablement for small businesses, rural sectors, and new borrowers further, illuminating that ecosystem that supports Bharat's growth. So, as we open the summit, I invite each one of you to make this more than a conversation. Let it be a platform for partnership, a stage for bold ideas, and a launchpad for action. Because the future of banking is not just digital. It is AI-powered, credit-driven, and purpose-built to serve Bharat. Let's create a system that scales for Bharat and globalizes India for every dream. Thank you for being here. Let's get started. Thank you.
Thank you. Thank you so much for setting the tone for the evening. You already now know what to expect. And this is going to be an insightful, fantastic time that we have all been looking forward to, and we have put together with a lot of interest, care, and thought. Up next, it's time for the keynote address. We are very honored to have with us a leader whose guidance has been important in shaping the policies and direction of India's financial sector. His insights continue to play a very critical role in strengthening the foundation of India's banking system and driving its evolution to an era of transformation. Please join me in welcoming Mr. Rajeshwar Rao, Deputy Governor, Reserve Bank of India, to deliver the keynote address.
Thank you, Mugdha. Good evening, everybody. Distinguished guests, participants, ladies and gentlemen. I'm delighted to address this august gathering of distinguished persons and key stakeholders across the financial spectrum on the theme of banking that builds Bharat, AI-powered, credit-driven, which is extremely contextual and relevant and encapsulates the spirit of Viksit Bharat. The Indian banking system has time and again exhibited its capability to embrace and adapt to newer technologies. Beginning from the early days of computerization in the 1980s, to the spread of ATMs in the 1990s, the expansion of internet and mobile banking in the 2000s, the interoperable infrastructure for payments, data repositories, and data sharing since 2010, the banking sector has adapted successfully to the requirements of the changing times and has over the period made banking more efficient and inclusive. Banking has now entered into a new phase of evolution driven by digital democratization. A prime example is the homegrown unified payment interface, which has made India a global leader in digital payments, which reinforces our belief that responsible innovation can be a powerful driver of progress. The Government of India has articulated an ambitious vision of Viksit Bharat that is transforming India into a developed country by 2047. This sets the tone for the next step in our technological journey for the financial sector and more specifically in the banking sector. Under Viksit Bharat, the goal is for every adult to not only have a bank account, a target largely achieved under the Jan Dhan Yojana, but also have access to affordable credit, insurance, and investment options. The endeavor of banking sector should be to ensure that the benefits of banking, more so of credit accessibility, is made available to the customers across all segments on a fair, transparent, and affordable basis. Over the years, the banking credit has been robust, averaging around 10.5% over the last 5 years. The share of retail credit has gone to about 32%, while the share of credit to MSME sector has been growing steadily, forming almost 18% of the total bank credit as of March 2025. Before delving into the role of new technologies, let me briefly touch upon the steps taken by the RBI over the years to increase the flow of credit. RBI has undertaken several measures to expand both the reach and depth of credit by reducing friction, increasing access points, and lowering the cost of financial service delivery. Key initiatives include the Aadhaar-based KYC, the Central KYC Registry, the revised priority sector lending norms, partial credit enhancement guidelines, and the account aggregator framework. In response to the growing digitalization of credit, the digital lending guidelines were introduced to ensure transparency, fairness, and protecting data privacy while enabling direct fund flows through digital lending. The RBI has also enabled formal credit access through frameworks like the TREDS for the MSMEs, co-lending models between banks and NBFCs, as well as launched targeted refinancing schemes. More recently, the Reserve Bank has, in collaboration with its subsidiary, the RBI Innovation Hub, tested a prototype of a public tech platform for frictionless credit to enable seamless digital data flow to lenders. Building on this, the unified lending interface is being developed to transform credit delivery by integrating access to both financial and non-financial data, such as digitized land records, the GSTN data, property records, and satellite data, along with services like eKYC, the account aggregator framework, and the credit guarantee schemes. This ecosystem aims to make lending faster, cheaper, and more accessible to the underserved segments. Together, this digital public infrastructure and an enabling regulatory framework would help to drive inclusive credit growth. Having said that, a lot of distance still needs to be traversed as the gap in credit penetration persists. Even today, only about 25% of India's adult population have formal access to institutional credit, while in the MSME sector, which contributes almost 30% to the GDP, only about 40% of the credit needs are met by the formal institutions. While the Financial Inclusion Index developed by the Reserve Bank has shown steady improvement, rising from 53.9 in March 2021 to 67 in March 2025, which reflects the growth in account ownership and credit access, scope remains in effecting improvement in the usage and quality of the services delivered. The gap between inclusion and credit access is a challenge and an opportunity to the banking fraternity. The credit needs to not only grow in terms of volumes and numbers, but also needs to be directed towards productive sectors that deliver higher multipliers, such as the MSMEs, infrastructure, informal sectors, and the rural population, to achieve not just the goal of a Viksit Bharat, but a Samaveshi Viksit Bharat. Driving the next credit revolution would require harnessing new technologies. Over time, the role of technology in finance has shifted from improving operational efficiency to fully automating and centralizing previously manual fragmented processes. Among the emerging technologies, artificial intelligence stands out for its vast potential for strengthening the internal operations and risk management to deliver faster and more seamless customer experiences. Reports indicate that nearly 68% of the banking and financial service industry organizations in India adopt some form of artificial intelligence in 2024. An RBI study of the bank's annual reports also shows a sharp rise in the reference to artificial intelligence, underscoring its strategic importance. While both demand-side factors, that is the profitability, competition, and compliance efficiency, and supply-side drivers, that is technology advances, data growth, newer business models, influence artificial intelligence being adopted, supply-side forces remain the primary catalyst. Artificial intelligence as a discipline has evolved over the decades and has seen rise of machine learning systems which can learn from historical data to make decisions, often with high accuracy. Indian banks and non-banks embarked on the artificial intelligence journey nearly a decade ago, mainly handling at that time large volumes of information and supplementary analysis which added value without displacing established systems. The adoption has since moved from deployment of artificial intelligence for back office functions, for efficiency enhancements to more varied use cases such as areas of fraud risk management, optimizing IT operations, facial recognition for KYC, credit scoring, claim processing, and customer-focused services. As observed in the surveys conducted by the Reserve Bank in 23 and 24, more than 3/4 of the banks have deployed artificial intelligence-powered chatbots for customer service. This marks a fundamental shift where AI is no longer just an enabler but a participant in the decision-making, product design, and customer engagement. Though the banks have been using artificial intelligence in some areas of lending, this is a potential use case. There is a potential use case for its usage across other areas of the credit life cycle. Let me highlight a few. One is credit inclusion. An important use case would be in the way credit is assessed and distributed. This would require supplementing existing assessment methods with broader data-based and more refined analysis, whereby financial institutions could gain additional perspectives on risk and capability of the potential borrowers. This would be a significant game changer to address credit requirements of the millions of credit invisibles, that is, the people with no formal credit history. However, given the availability of other digital footprints, artificial intelligence can be adopted to leverage alternate data sets to assess creditworthiness, especially that of the new-to-credit customers. This would mean a paradigm shift from asset-based lending to cash flow and alternate data-based lending, promoting a journey from exclusive banking to an inclusive digital finance. Government of India has also recognized the artificial intelligence potential to drive financial inclusion and has started initiatives such as the Grameen Credit Score, which aims to provide underserved communities with formal credit access by analyzing alternate financial data including UPI transactions, government subsidy receipts, and utility payments. Artificial intelligence also influences the turnaround times. It enables banks to process large volumes of customer data quickly, accelerating credit decisions and service delivery. This is especially valuable in time-sensitive sectors like sanctioning of working capital for the MSMEs, where the AI can analyze diverse data sets like bank statements, payment histories, GST filings, e-invoices, trades receivables and patterns, and public records. It also aids lenders in assessing seasonality, supply chains, inventory cycles, customer concentration, thereby help to assess the overall credit worthiness of the MSMEs. Of course, in credit appraisal, the banks can embrace AI algorithms for leveraging behavioral analytics by analyzing a vast amount of transactional data for detecting patterns indicative of creditworthiness and stable financial behavior, which can lead to more accurate credit assessments and improve the decision-making processes. Artificial intelligence ability to dynamically assess customer preferences and behavior can empower banks to offer customized credit solutions tailored to an individual's financial capacity rather than relying on outdated credit assessment. This not only improves the loan accessibility but also ensures that the borrower receives fair and structured financial products that align with their needs. AI-based early warning systems can help to lenders to monitor credit portfolios more effectively through dynamic risk scoring and real-time default probability tracking. By flagging early signs of financial stress, these systems protect the lender's balance sheet while giving the borrowers a chance to correct the course. The goal ultimately is not just to lend more, but to lend better. Artificial intelligence would also play a key role in automating document verification by assessing image quality, ensuring compliance, and reducing lead rejections. It can accurately process large volumes of records, classifying, extracting, and validating key data, thereby improving efficiency and minimizing errors in the lending processes. One promising use case of artificial intelligence is the development of multilingual chatbots and voice assistants which enable customers to interact with banks in their native language. This is a revolutionary change as by localizing the user experience, the AI can enable more people across different languages, literacy levels, and abilities to confidently use formal banking services. I'm told banks are also experimenting with using artificial intelligence to enable staff to respond to customer queries, which can enhance the customer experiences going forward. Timely resolution of customer queries boosts trust in the banking system and encourages deeper engagement, furthering financial inclusion. As digital access has expanded, so too has the customer complaints. This highlights another use case for the artificial intelligence. It can efficiently categorize, prioritize, and route complaints, enabling faster proactive resolution by detecting patterns and addressing root causes before the issues escalate into grievances. Artificial intelligence-powered loan servicing platforms can create personalized repayment solutions and reduce operational errors across servicing and for portfolio management. They can also provide new ways of loan servicing by supporting collections and recovery through prioritized outreach strategies. AI can help to strengthen compliance with auditable trails of measures initiated for recovery. AI also holds potential for safeguarding the financial system itself. As cybercriminals increasingly use AI for sophisticated attacks, the regulated entities can leverage artificial intelligence-driven tools to protect customers and detect threats. AI can monitor large transaction volumes in real time, flagging anomalies that may indicate fraud or money laundering, especially in complex areas like crypto transactions where parallel financial channels exist. With the fintechs advancing rapidly, the regulated entities are increasingly partnering with them across the credit life cycle. A key model, digital lending under banking as a service, involves embedding processes like KYC, credit assessment, and recovery directly into the fintech platforms. While such collaborations enhance financial inclusion and innovation, they can also bring risks such as blurred accountability, data misuse, inadequate grievance redressal, and potential mis-selling. The guiding principle to address this remains the premise that regardless of the model being used, accountability ultimately rests with the regulated entity. Technological advancements come with the challenges that the regulated entities must recognize, as these risks can undermine the benefits of innovation. For example, the recent Supreme Court ruling on the video-based eKYC highlighted that mandatory automated processes may create barriers for people with disabilities, underscoring the need for fairness and accessibility in technology adoption so as to avoid exclusion. Artificial intelligence without proper controls can introduce risks like algorithmic bias, lack of transparency, ethical concerns, and systemic vulnerabilities. It can also amplify the existing risks such as third-party dependencies, concentration, model, cyber, and data privacy risks. Let me highlight a few of this. Even as artificial intelligence adoption grows, financial institutions increasingly rely on complex networks of external service providers, cloud platforms, artificial intelligence vendors, and data aggregators. These interdependencies create hidden vulnerabilities where a disruption or a breach in one link can cascade across multiple institutions, disrupting critical services. The complexity and opacity of these layers makes it difficult to identify risks, allowing them to accumulate unnoticed and spread rapidly during shocks. A critical vulnerability of artificial intelligence is its potential to synchronize behaviors across financial systems. When institutions use similar models trained on overlapping data, their decisions on asset pricing, credit assessment, trading may align, creating hidden linkages. This can amplify market stress, spreading shocks rapidly, worsening liquidity shortages, increasing asset price volatility, and trigger sharp, self-reinforcing market swings. The integration of artificial intelligence into the financial system, especially through new interaction methods and increased reliance on specialized providers, expands the cyber threat landscape in unpredictable ways. AI strengths such as reliance on large data sets, open interfaces, and automated decisions also create vulnerabilities. Malicious actors can exploit these through adversarial attacks or compromised training data, potentially corrupting artificial intelligence outputs. Even a single breach can disrupt critical operations and undermine trust in the artificial intelligence across the sector. Then, of course, the one important point is the model risk. Unlike traditional models built on clear rules and well laid out assumptions, artificial intelligence models operate through dense, opaque algorithms, which we refer to as black boxes, and may evolve with the data which they consume. This introduces the risk of prejudice within the models, where biased data, opaque design, or untested assumptions may lead to biased outcomes of the model. Such distortions can lead to unfair credit assessment, exclude deserving segments, or conversely extending credit where risks are understated. AI is only as strong as the data that shapes it, and this leads to the host of vulnerabilities emanating from data quality. Currently, while much of the financial data is structured, much more of the data is fragmented across systems, often in inconsistent formats, somewhat incomplete or outdated, or skewed by historical biases. When such data flows into AI models, it can produce results that may appear authentic, but suboptimal, and in some cases may produce wrong outputs. Over-reliance on such models can quietly turn data gaps into large-scale misjudgment and wrong business decisions. Generative AI models are often trained on publicly available data like news articles, stories, and explainer videos, and this may lead to intellectual property and copyright infringements. The Reserve Bank's Financial Stability Report has pointed out that high market concentration in critical third-party service providers of cloud and AI services, noting that heavy reliance on a small number of tech players could create single points of failure. Such concentration risks are compounded by vertical integration of certain providers who supply not just models, but also the underlying infrastructure and the data sets. While AI is transforming many of the processes of the financial institutions, the rise of generative AI has also lowered the barriers for fraud, putting powerful deception tools in the hands of malicious actors. Deepfakes can mimic voices, faces, and documents with unsettling accuracy, while AI-generated phishing lures, faking identities, and forged credentials can slip past traditional checks. In the light of these multifaceted risks, some of which I have touched upon earlier also, it becomes crucial that adoption of AI in banking sector must be done in a responsible and measured manner. The excitement around the AI's benefits should not overshadow prudent risk management. In this context, the following aspects become crucial. First, of course, is governance. A robust governance is indispensable for ensuring the integrity of data, the reliability of the models, and mitigation of the risks associated with the adoption of AI. The financial institutions should have in place a comprehensive strategy for AI adoption. It should be accompanied by clear policies, risk appetites, and ethical standards that cascade throughout the organization. Robust monitoring and reporting mechanisms should be put in place to ensure alignment between the innovation goals and institutional stability. Further, in a regulated industry like banking, it's essential to understand how a model arrives at its decisions, making explainability a critical requirement. Thus, there is a need for financial institutions to invest in explainable AI frameworks that provide clear, auditable reasons for loan decisions and services. Strong governance is central to the managing of the AI-driven model risk. While AI can automate and recommend, humans should be responsible for the decisions. Financial institutions, while adopting artificial intelligence for business processes, should implement the principle of keeping a human in the loop to ensure that AI is leveraged as a tool to support and enhance human decisions and not replace them. High quality data is the backbone for safe and effective AI in finance. While the RBI already collects data through supervisory reports, regulatory returns, and surveys, the introduction of model risk guidelines aligned with global best practices could extend the scope to include data on AI models used by regulated entities. Financial institutions should therefore adopt robust data strategies incorporating diverse, reliable indicators that reflect both the scale of AI adoption and the associated vulnerabilities. When AI is used for credit decisioning or financial inclusion, especially through alternate data sets or use of alternate data sets, customer data becomes central, making privacy and security paramount. The Data Protection Act of 2023 provides the legal framework for responsible data use, and the financial institutions must ensure compliance through a consent-based, privacy-first data handling practices. The continued investment in research and development is critical for advancing the capabilities of AI in the lending lifecycle for unlocking new opportunities. Research efforts of the financial institutions should focus on improving data quality and accessibility, developing novel artificial intelligence algorithms for enhancing credit inclusion, and addressing key challenges relating to bias, fairness, and interpretability of the credit evaluation. Collaboration and knowledge sharing among the industry stakeholders, including financial institutions, fintech companies, and academic institutions, is essential for driving innovation and addressing the common challenges in the AI-driven credit processes. This can foster the development of best practices, standards, and frameworks for responsible AI use, promoting transparency, fairness, and accountability in credit evaluation. As AI adoption gains traction, regulatory oversight is crucial in ensuring an efficient, responsible, and fair adoption. Recognizing the increasing usage of model-driven credit assessments and decision-making in the regulated entities, the Reserve Bank has issued a draft circular on model risk management in credit, setting out the expectations on governance, validation, monitoring, and accountability. Building on this foundation and recognizing the increasing usage of models by regulated entities, not only for credit functions, but also wide spectrum of processes, we could look at as expanding the scope of these guidelines. As technologies like artificial intelligence are generally not adopted uniformly across the sector, and owing to presence of varied types of entities with different scales, the principle of proportionality also has to be factored in. The objective would be to ensure that all regulated entities can adopt technologies best suited to their business models and customer needs, while effectively managing risks as explainability, algorithmic bias, resilience, and over-automation. In continuing of this approach, the recently released report of the Committee for Framework for Responsible, Ethical, and Efficient and Ethical Artificial Intelligence has laid down the 7 sutras for trustworthy AIs and has emphasized the need for a robust model risk management framework within the regulated entities. Over the decades, Indian banking sector has exhibited its ability to adopt meaningful technology. Even as AI transforms financial services, it's clear that there is a development which is not a mere upgrade but a major shift impacting product, processes, and operations. The long-term implications of AI adoption on the financial system remains uncertain, but exhibits potentially far-reaching consequences. Therefore, an imperative for the financial sector to approach AI adoption with foresight, investing not just in innovation but also in resilience, building strong governance structures, diversifying from dependencies, and engage in continuously assessing the emerging risks and ensuring that their AI strategies align with long-term safety and sustainability of the financial system. Ensuring AI-driven decisions are ethical, unbiased, and transparent will be paramount in building a sustainable AI-powered financial future. This calls for optimistic vigilance, wherein AI and other technologies in banking are neither feared nor embraced blindly, but navigated through. The Reserve Bank, on its part, will continue to provide an enabling regulatory environment that together we can build a banking system that truly builds Bharat, and not just builds, but transforms Bharat. Let me sign off with a thought. Trust is the currency of banking. Even as we broaden the credit coverage using algorithms and digital interfaces, maintaining this trust will be the biggest challenge and also our biggest responsibility. Thank you.
Thank you. Thank you so much, sir. Thank you, Mr. Rao, for that thought-provoking address. You have given us not just a view of where banking stands today, but also a compass for transformation and what to expect from the industry ahead. And we will carry these insights into the rest of our discussions tonight. We are now moving on, ladies and gentlemen, for our first conversation of the day that turns to the backbone of India's growth story, credit. For Bharat to truly rise, access to credit must go beyond the metros and reach entrepreneurs, as Sir also mentioned in his very special address. It has to reach more entrepreneurs, MSMEs, and communities that are building the new India. Our first panel today is titled How Banks Can Boost Lending and Build Bharat. And we will explore how India's banks can now reimagine lending, not just as a financial service, but also as a tool for nation building. To moderate this session, I'd like to invite CNBC-TV18's Lata Venkatesh. And joining her are her panelists. We'll take a moment. Our gratitude to Mr. Rao for being here, sir. Thank you so much for your presence and your time, sir. All right, we now proceed for our first panel of the day. I wish Sir could have stayed, but a busy man, but he gave us a lot of his time, and I'm grateful for that. Lata, can I have you on stage, please, for our first panel? And can I also invite all my panelists today? Ashok Chandra, MD and CEO, PNB, Mr. Ram Mohan Rao Amra, MD, SBI, Rajiv Anand, MD and CEO, IndusInd Bank, KVS Manian, MD and CEO, Federal Bank, Rajneesh Karnatak, MD and CEO, Bank of India, and Dr. Dev Datta Chand, MD and CEO, Bank of Baroda. Ladies and gentlemen, could we have packed a more powerful panel for you? A big round of applause for the most sought-for men from the banking industry who have given us their time. Thank you so much. Over to you, Lata.
Thank you. Well, I think we have about 200 trillion rupees sitting on the dais, almost the entire banking sector over here. 1/3 is on my right, and then if we add up the others, we are almost covering the banking system. Maybe 20% short or 25% short. Well, the topic given to us, AI-powered and credit-driven. So let me start with credit. Though, of course, to get the credit going, we need the deposits as well. But the first questions really are on credit. The Reserve Bank has flooded the system with liquidity. But are you finding enough borrowers, Mr. Rao?
I think maybe your concern may be stemming from the fact that Q1, the credit growth has been tapered. And
it is less than 10%, sir. And now deposit growth has crossed credit growth.
I will dwell on one or two factors as to what led to such slow growth before I dwell on like what is looking like. In the sense, like particularly if you look at the segment like corporate, it grew hardly by 6%, right? And there are reasons for that. Generally, seasonality is one factor. Second factor is they were able to access debt markets through the CPs and through the bonds, etc., at a very, very competitive rate. And my team tells me like this is not the first time this happened. Earlier also, whenever the rate cycle was reversing, I think corporates were looking for that opportunity to tap. But in Q2, what we have seen is like a particularly post-MPC, we have seen some hardening of yields also. So we have seen the volumes in Q2 actually coming down. CP volumes have come down. Bond issuances have relatively come down. And including even the CD issuances from the banks has also come down. That also shows like there is not that kind of pressure on the deposits kind. But looking at H2, like what is that in store for us, we are very optimistic. While there is this uncertainty or the cloud hanging around the tariffs, etc., I think the GST2 reforms are very, very timely, and the monsoon is favorable so far, and the tax cuts are yet to play out, whatever were extended in the budget. So we are very optimistic that this is going to lead to something like a virtuous cycle, which will create the demand, which is placing more disposable income in the people's hands, which will lead to investment, which is private capex. I think with that concern was always that
corporates to come and take money.
We are expecting because they need to see the demand. Obviously, I think they're adopting a wait and watch. That is what my assumption is. So once they see this demand reviving, particularly the festive season augurs well, I think even anecdotal inquiries, very much a number of inquiries are
Will
there.
you all do your guidance of 13%?
I think based on these facts, I mean, see, while the Q1 might have put a color around the 12-13%, but I think for the factors I mentioned, like whether it's a GST or whether it is a monsoon, etc., we are very optimistic that 12-13% growth is still achievable. But of course, subject to the fact that actually tariff is going to be resolved, if not in a month, at least in 2 months kind of time. That is expectation. If it is not, then obviously 1 or 2 percentage points can
Okay.
come.
Well, let me get someone from the private sector on the same issue. What's your sense, Mr. Manian? I actually heard a private sector bank telling me, Reserve Bank has given us all this money. Kisko do? Was his question. I mean, not all retail, I mean, he was referring to retail, are ticking all the boxes that I have for due diligence.
Lata, I think we are going through some volatility, right? The expectations on the GST has held back some demand, consumer demand. So tariffs are causing some uncertainty. My feeling is that as we progress through the next quarter, I think some of these uncertainties will clear. And hopefully 22nd September is a D-Day, and then we know that car sales are held up, they are booked but not sold, right? And that is happening across products. So one is hoping that we are going to see a turnaround post 22nd September on consumer side demand. And usually consumer side demand should lead to consumer credit demand as a follow-up. So we are optimistic about it.
Okay, well, let me just take one round of rapid fire from all of you. Give me your number, your credit growth number. Mr. Chand.
We said earlier 13 to 15%. I'll stick to it.
Sorry, once again, sir.
13 to 15%.
13 to 15?
Yeah.
Oh, that's excellent. Rajiv? For the industry and for Innocent, if you can.
I think industry should be 11 to 12%. I think if we can get there, we should be happy.
You would do that?
No, that's for the industry at the moment.
Yeah. You don't want to give a number for yourself?
No, not yet.
Not yet. Mr. Karnataka?
Yeah, with GDP pegged at, say, for FY26 at around 6.5%, traditionally the credit growth is double of that. So I would say 12 to 13% on a safe side.
So all of you are within that 12 to 15. Mr. Chand is more optimistic. So
I think, as I said, we stick to the guidance, whatever you said, still optimistic.
Okay. Mr. Chandra?
Yeah, 11 to 12% I will be expecting, and there is enough room to substantiate that figure also. I will discuss in detail about it.
Okay, 11 to 12 is the full year average or exit number?
No, that will be the full year YOY average, what we call
then
about
your
it.
second half is almost what Chand is saying.
Yeah.
Same, I am also in the 11 to 12%.
For the full year. Yes. Okay, that's better than at least we are reaching double digits. For a nominal GDP of 8.8, I think 12 is still very positive. But then, is the deposit war over, Mr. Chand?
So look, when we said the growth would be, because the RAM segment is going very strong. If you look at my number for June, the RAM means retail, agri and MSME, it was the growth of almost 16% therein. So I think going forward, typically we are at Q1, Q2 yet to announce. And Q3 and Q4 are the busy season, right? So both on the deposit side, advances side, a lot of uptake would happen. So in scenario like that, I'm quite optimistic that even if the deposit growth is low, but there is a system liquidity going to be very strong in that way. Mobilizing money is not a challenge at all. And in the same sense, funding the asset out of the liability, I'm not thinking of any challenge going forward.
Okay. Funding the asset out of the liability. That is the real problem, Mr. Chandra. Because yesterday we had that data coming out of the CRISIL analysis. They are saying that household share in deposits has come down from 64 to 60, which means that it is getting replaced by institutional credit, which by its very nature is volatile. So do you think that banks are increasingly going to become retail lenders also? Because your liability is becoming volatile. Will you all stop or at least sizably reduce long-term lending, infra lending?
No, I don't subscribe to that logic at all. See, all the public sector bank and in fact in broader sense, all the banks, our goal is not only to restrict our lending to the retail or agri. In fact, we are doing a lot of infra lending, and as on today also, we have a good pipeline of infra lending. We have a good sanction book for the various infra lending, long-term lending, so and all. So I don't see that we are going to restrict it to the retail segment only. Yeah.
No, I agree with you that this far, you still have 60% of households, and therefore some term deposits are stable. But if this trend continues, in just about 3 years, the share of household has come down. So is it likely that going forward, banks will move out because of the ALM mismatch, not because you don't want to lend to infra, but you don't have long-term liability?
No, that is not the case. In fact, see, what has happened, some diversion of the fund has happened from the household saving in the bank. It has moved to the mutual fund and the stock market. And see, this is the process. When the country is moving from the developing to the developed nation, that is the gradual, the shift has to happen, and that is happening. But it doesn't give me a room to understand that, yes, the lending also has to happen only to the retail segment. No, it doesn't happen like that, yeah. See, we are getting, there is a drop in the CASA. Yes, right, the fund has gone to the mutual fund. But we have a good retail term deposit base is there, having so much presence across the country. So we have good retail term deposit, which we are getting it replaced by way of the CASA now. So overall deposit, I think we don't see any challenge, and when the liquidity is there in the system, I think deposit growth is happening at the speed of around 11 to 12%.
Deposit growth
now
is happening.
Yeah.
I'm only,
so when you have the deposit, and when you have the opportunity to go to the market to find out any good project and all, I think we are all ready, and the public sector bank is the player who is dominating in the infra field.
Okay. The longevity of your deposits is what I'm worrying, not quantum. Quantum will definitely rise, but
can I supplement actually? Yeah. I think when you look at the greenfield project, particularly in a sunrise sectors, etc., I don't think they will be straight away in a position to access bond market or anything. So the banks will have to take care of the infra. But what's happening is once they achieve the COD, once they achieve the stability, then there are a lot of takers for funding them, right? And eventually, of course, we will also reach a kind of maturity where the resource requirements of large corporates or infra are going to be met through a combination of bank loans, corporate bonds, and equity. I think that's still a far away. I'm not saying it is going to happen in a day or two, but eventually we'll be moving towards that direction. But the role of banks is very much there, particularly the large banks, which have traditionally been underwriting the infra loans like SBI and others. I think I don't envisage any diminishing role for banks in infra funding.
There was a corporate who told me that my first source of funds is PLI. After PLI, I go to equity market. Then I go to bond market, and then I go to the banks. But obviously, this was someone who is in the PLI category. But Mr. Karnatak, a similar question to you. Where is the credit demand coming from? Are you looking at long-term loans at all, or are you going to stick to, say, MSMEs and shorter-term credit?
So just to build up on your previous question, Lataji, just wanted to supplement what was said. So CASA ratio, if you see, it is at around, for the scheduled commercial banks, at around 37-38%. Right? There is a challenge in CASA, as rightly said by my previous speakers also. There is a shift which is happening in the household savings, as you said rightly. But see, the color of money is changing. Like when the money is going outside the banking system from CASA to say mutual funds, to pension funds, and to the insurance company, this is coming back to the banking system from these three players, right? Once it is coming back to the players, so there is no challenge as far as the deposit is concerned. If you see the latest RBI data, which is of 23rd of August, for the scheduled commercial banks, the credit growth is at around 10.22%, and the advances growth, the deposit growth is at 10.22%, and the credit growth is 10.03%. So there is a delta of 19 basis point now. This is against the data which was there in March 25. In March 25, the credit growth was 11.3% and the deposit growth was 10.2%. Okay. So the things are changing now. As regards where we are giving for, see, we see a lot of credit growth happening in the RAM sector, particularly retail, MSME and agriculture. If you see for all the banks, again the RBI data, there the credit growth on a YOY basis as on June was more than 15%. yes, I agree that in the corporate segment, the credit growth on a YOY basis is in single digit. It's not even 10%. So that is where the challenge is. If we are able to pick up that credit growth in the corporate sector, definitely the credit growth would be even higher for the financial year 26.
Okay. Well, there is another problem which bankers are speaking about in terms of deposits. I'll come back to credit. And that is mule accounts. I mean, is this a huge issue? While at one point in time, maybe not too long ago, banks were rushing to collect deposits even digitally. Now there is a scare, Rajiv.
So I just want to add to the previous question as well. I think not now, but always, almost all the deposits that banks get is up to 1 year.
Yes.
But one has to look at it from a behavioral perspective. CASA typically behaviorally stays what is core CASA for something like 5 to 6 years. And that is what gives us comfort. And of course, you have capital. The second is, as we think about long-term loans, particularly to infra, contractually, these loans are anything between 15 to 20 years.
Yes.
But behaviorally, once again, we have seen that most of these loans get refinanced in between 5 to 7 years. Very similar to what happens to retail mortgages. While the mortgage loan itself is 15 years, we've seen that behaviorally, they get repaid in 7 to 8 years.
If the infra companies come, bankers are willing.
Absolutely.
And able.
But where are they? I mean, I think the question to ask is, where are the people asking for, bank loans? But to the question on mule, absolutely. I think it's become a big issue, for banks. It's become a big issue for, for the government as well. And let me just give you an example of how innovative, scamsters are. We've seen instances where a salary account has been opened of, let us say, TCS. The salary has come to that account for 6 to 8 months. The bank thinks that, yes, this is a salaried customer of TCS. It pre-approves a personal loan, and then you find that the whole structure that was built is all wrong, is all fraud.
Fraud.
And so therefore, that is the kind of innovative ingenuity that you're dealing with as far as scamsters are concerned. And so therefore, this is an industry issue. We work very closely as an industry. We work very closely with the Ministry of Home Affairs. They track where the mule accounts are on a bank-to-bank basis. Ultimately, we have to use technology to be able to deal with this. But the point that you make is very, very valid. Because what is also important to us is if customers get phished or whatever, ultimately we're in the business of trust. And if customers lose trust, then all banks, not just the individual bank, has a problem.
Okay. Mr. Chand, would you want to add to that? Or is it that public sector banks have more branches and therefore e-KYC kind of accounts are fewer? Or is it that all of you face the same problem of fraudulent accounts?
Look, the issue remains with all the banks on the same manner, right? And mule account is an issue for the banking system. And let me also say that when banks do open mule account, not necessarily these are not KYC compliant, these are KYC compliant account. Okay. Only a later part of the time then they rent it out or these accounts have been used for a mule purpose. Having said so, now if you look at the entire ecosystem, there is a great deal of coordination between I4C, the regulator, the banks, everybody trying to address the issue. At the same time, recently there was also an announcement of forming a new company, DPIP, just to address the issue of mule account.
Yes.
So the issue is known, the issue is being addressed. But then it's not that because of mule account, bank would go slow on deposit, bank would go strong on deposit, opening more and more accounts, bringing inclusivity into the entire banking. But let me again say it's more of an awareness that can prevent the mule account being misused. And that is what, again, all the banks, including stakeholders, we are trying for that.
Okay. Well, ICICI, for instance, I mean, I can tell you the name, when they raised the minimum balance to 50 and then withdrew it, their fear was this, that maybe we can avoid mule accounts if we raise the minimum balance. But Mr. Chandra, on that, first of all, is it increasing cost? Because, you have to use more technology per account. And secondly, is this a call, as Sohini was telling us from NPCIL before we came in, that is this an instance of interbank cooperation so that you are able to weed out mule accounts?
Yeah, first of all, it has...
cost.
It is there, it is there. And it has nothing to do with the minimum balance per se. The people can open that account with 50,000 average balance also, and it can be rented because mule account concept, what Mr. Chand was also mentioning, it is a full KYC account. There is no issue of the KYC or the due diligence in that particular thing. It is basically the renting of that valid account is being rented out and it is being misutilized now. So how you can handle it? Now, almost all the banks, including my bank also, we have come out with different models in my EFRM, that enterprise fraud risk management system, where we are building the different scenarios. Yes, the costs are there now because for each and every transaction, now the different models, risk categorization is happening. And we have created the different scenarios in each and every transactions now. Each and every account which is getting opened, we are fixing the limit of transaction which is going to happen in that particular account on a monthly basis or quarterly basis. And based on that limit, if it gets 80%, if it gets crossed, then the SMS flows to the customer that you have crossed this trigger point. When it comes to 100%, then we are blocking all the alternate delivery channel in that particular account, and the person has to go to the branch. So these are all these problems, and the cost has happened because the numbers are increasing now. And in the system, banking system level also, the I4C is there, and now NPCI is also come out with a different model now. Each and every, the transaction which is happening in NPCI, they are giving a score for the transaction now. But all these things are indirectly, it is the cost is involved in that, because that much IT integration, digital integration, AI has to be there now. So when they are mapping and giving the score for each and every transaction, and then they are categorizing the transaction in the high risk, low risk, medium risk. And they had asked the banks to get integrated. We have integrated directly with the NPCI. And if the account is categorized, the transaction is categorized as the high risk, then it flows in my system, and it is mapped with the mobile number. If that person is having the same mobile number, and then with the mobile number, we search the account number in the system, and then that account gets triggered in my system also. And it is flagged out that, yes, something is happening in this account. We are not blocking the particular transaction,
but you are watching it.
Alert gets generated.
Fair enough.
So all these things, it has happened because of the large volume of the mule accounts are happening in the system.
Yeah,
so it involves cost, it involves a lot of IT infrastructure also. So no doubt, I think it is at the cost now.
With that, that brings me to the next round of rapid fire. The first is a very easy question, actually. Will the Reserve Bank cut rates in October or one more? Manian?
Not in this round. I think not just yet.
But one more cut?
Maybe one more cut, but not just yet.
Not in October. Not on October 1st. Mr. Chandra?
Yeah, I'm also expecting that one cut will happen in the full financial year. I am also feeling
October?
that not immediately.
Not immediately. Mr. Rao?
I think it depends upon whether the full benefit of GST2 is passed on, because my economist says 114 basis points.
Rapid fire. So
it may happen. Timing I am not sure, but it can happen.
Okay.
It can happen.
Chances of a cut.
Yeah.
Mr. Karnataka?
So 100 basis point repo has already been cut. So I don't foresee any cut in the...
No more cuts.
in
Zero.
October. Yeah.
Not in October.
Not in October.
Okay. Rajiv?
Certainly not in October.
Okay.
There could be another 25 basis points in the rest of the year, but I'm very certain that October we won't get one.
Okay. Mr. Chand?
Yeah, not to predict, but to anticipate, not this time. Next time possibly.
Okay. So this is what, you also said no, Manian. So 5:1. No cut.
It may happen.
Okay, so 6-0. No cut.
Timing-wise, I'm not sure.
Okay.
That's what I said.
Fine. Therefore, I wanted to come to margins. Since most of you are anticipating one more cut, how much more can margins get shaved off, Manian? In basis points.
From the sector's perspective, I think the last rate cut will get transmitted through this quarter.
No, right? Just give me a number. How many basis points can margins fall
if you broadly take, most banks have 50% of their assets, I'm taking a broad number, 50% of their assets as repo-based assets, repo-linked assets. So the impact has to be 25 bips for a 50 bip cut, right? But some of that would have come in last quarter, so I would say as a sector 15.
Okay, I just want a number, sir. How much more can margins dip? One number.
See, Q1, whatever the NIM was there, I think more or less we will be maintaining the same in the Q2 also.
No
yes.
more a dip in margins.
No. We have taken some corrective actions.
I think I can't put a number, but it will get normalized over a period of time.
No, I know. I'm just asking. Okay. Any more dips, margins?
So it will get normalized in the Q3, frankly speaking. And traditionally, what we have seen, a 25 basis cut in the repo will reduce the NIM by around 10 basis points.
Okay.
I think you will see NIMs coming off in this quarter as the impact of the 50 basis points cut that we've seen the last cut. But I think, from Q3 onwards, you will actually see NIMs going up as the full impact starts to play out on the liabilities side.
We had a good NIM for Q1, actually at 2.98, right? So we still expect some bit of pressure in Q2.
Okay.
But Q3, Q4, there would be a significant pullback happening on that.
Fair enough. Okay, I have to call it a day because the finance secretary, the Department of Financial Services secretary is ready for us for his conversation. I'll just ask one more question of you. Mr. Rao, do you fear an MSME problem of bad loans?
No,
Because
not
in
at
the
all.
first quarter, we saw some of the banks really give loans hand over fist to MSMEs, and the NBFCs, many of them, reported bad loans. So do you think that is the next area to watch?
No, at least for us, for my bank, I can say, because very significant amount of underwriting we are doing through the digital means, particularly using AI. We call it a business rule engine. Just to share a number, I think during the last 15 months, I think we have underwritten more than 200,000 loans worth around 70,000 crores. And when we looked at the vintage delinquencies, they are exactly within the range what we anticipated. So my overall NPAs or SMEs are very range bound. At least in my portfolio, I am not seeing any stress buildup.
Okay. I would have loved to do a rapid fire on that, but we're out of time. Gentlemen, thank you very much. The big takeaway is they are not expecting a rate cut on October 1st. Thank you very much.
Thank you. Thank you very much.
Thank you.
A louder round of applause.
Thank you, gentlemen. Thank you, Lata. That was one power-packed couple of leaders coming together and talking to us about what actually is happening on ground. And up next, we have a very interesting and special keynote on driving credit growth in India's new economy, followed by a quick fireside chat with Shireen Bhan, Managing Editor, CNBC-TV18. Well, credit is the lifeline of economic momentum, and in India's new economy, it must reach far and wide to the most remote corners of the country. And the government has been playing an elemental role in enabling this shift, and to help us understand how policy is translating into on-ground transformation, we are honored to be joined, albeit virtually, by M. Nagaraju, Secretary, Department of Financial Services, Ministry of Finance, for a very special keynote address. So welcome to CNBC TV18's Summit on Banking Transformation.
Thank you very much. Thank you very much for the invitation. I am very happy to participate in the Banking Transformation Summit. I also thank CNBC for organizing such kind of summits, so that there is a dialogue among the industry leaders on what India needs to do in the banking sector.
Well, sir, thank you so much for the opportunity, as you said, to engage in a dialogue with you. I wish you could have been here with us in person, but for the audience here, let me tell you that he's been very busy organizing a manthan of public sector banks that's been happening in Delhi for the last 2 days, and that's why he isn't here with us in person. So, Mr. Nagaraju, let me start with exactly that, because there's been a lot of interest in what transpired in that 2-day manthan. How much did you churn turn the banking sector, sir, so to speak. So give us insights into what transpired in that meeting. What was the big takeaway? What was your message to banks? What was the message from banks to the government?
No, I think this is, we had this is the third month and we did after 11 years, during the 11 years. And I think all of you know that the results of first Jnana Manthan in Pune, and then second Manthan in Delhi, and this is the third one. While I have mentioned, I think all of you are aware, the first one and the second one are related to how do we survive because of the NPA burden, credit issues, and how do we, and then of course the PCA. Now, because of the steps that government has taken, most of our banks are actually very healthy now. I think all of us know we have made the highest profits ever with the lowest gross NPAs and net NPAs. And we also, our professional managers, the bank recruitment process is much more professional now, much more learned, and much more dynamic compared to the past. I think all of them are actually showing results on the bottom line and the profits we are declaring. Now we felt, all the banking leaders, we all felt that now this is the time for India banking industry to take a leap of faith on the next phase of both reforms and lending. We want to become bigger. The Indian banks want to be bigger. And I think all of us know, in the top 10, we have only 2 Indian banks in the country, SBI and NBFC. I think we need much more. We are now currently 4th largest economy, and in the next year, we will be 3rd largest economy. But we have only 2 banks. And given our size of the economy and the credit requirements and the potential, I think all of you agree with me when we say that we deserve to be there. Our banks deserve to be there in the top 10, not just top 50. We have to be, at least 1 or 2 should be there in the top 10 in the world. I think that we need to work. There are so many, I think all of you are much more well informed. I'm not saying, so it can happen in several methods. And one is, of course, the growth, organic growth. We have a great potential. We need to do that. This is one issue. And then second issue is, while growing, we need to be very cautious to ensure the healthiness of the banks have to be protected. That's the first fundamental principle of a banker. We need to be ensure our banks are not over leveraged, and we are healthy, and our capital base is protected, so that we'll be able to provide security and assurance to the entire country that the banks are with the growth of the country.
Well, Mr. Nagaraju, you've given us a big headline, sir, so let me build a little bit on that. You said India aspires to have more banks in the top 10, so clearly the government is going to prioritize size, of course, along with healthy balance sheets as well, as you pointed out. What will the route be to be able to get to the top 10, sir? Is consolidation the preferred option? Is consolidation likely to be the route that the government takes, especially as far as putting the PSBs in the top 10 is concerned?
No, there are several routes the government can take. The first fundamental route is organic growth, as I mentioned. There is huge credit growth potential in the country, both in the MSME and startups, in the defense, in the infrastructure, power sector, RE. There are huge growth areas, including shipping, post-development, shipping, roads. We have huge the areas of potential. Now, we need to have right projects to come forward, and then I think the bank should be able to lend. We need to have a capital. And now, this year, we are going to raise the capital 4 banks to also meet the SEBI guidelines below 75% of public shareholding. So, that is one way of raising, so that when the capital is there, we will be able to lend more. And in this year, till now, our credit growth is also very high. I think because of last year's the profits the banks have earned, our credit growth is also very high. And we are very confident, given the low inflation numbers and then availability of the liquidity availability in the system, we want to lend more. Okay, that is the message we want to give to the country.
Sir, you sidestepped my question on consolidation. While I understand that the government wants banks to lend more, and that certainly is something that you're working towards, but what about consolidation, sir? Is that something that is actively being considered at this point in time?
You know, we have consolidated all the rural banks. That I think you should have noted. From the 46 or 47 banks, now we are at 28. Now there is one RRB, one state, that we have successfully implemented. Now some of the RRBs now actually very big, especially RRB like UP, Andhra Pradesh, Gujarat. These are big RRBs. They are also going to play important role. But I think the banks are now free. I think, you know, the SBI is so big. Banks are free and all of them are free. They can look at the ways of becoming bigger. Okay, this is a long-term goal. I'm not only talking in the short term. I'm actually talking about Viksit Bharat 2047. When we have this 100 years of India's independence, at that point of time, we need to have larger banks, bigger banks, banks with influence globally, and so that the India is able to play a bigger role in the global markets. Okay, I'm not talking about short term. I think, Shireen, that you have to give me that.
I think it's good that you've made that very clear, sir, to this audience as well as to the markets, because there's been a lot of speculation on how quickly the government was looking at consolidating. But let me address the issue of reforms, because as you said, it is no longer an issue of survivability or stability. You have ensured, and the banking sector has ensured both, especially as far as public sector banks are concerned. So what next, sir, then, as far as the reform agenda is concerned for the banking sector, in the short term, in the medium term, in the long term?
Let me, since we all see, many of you are economists. In the long term, we're all dead. I will talk about long term. I'm not going to talk about short term. Okay, that is my tenure. Now, long term, I think the banks have to be. I would actually say that one, the goals of Viksit Bharat that the Honorable Prime Minister has repeatedly mentioned to the entire country, and the role of financial sector in meeting the goals, I think we have to keep that in the mind. I think that should be our objective. The financial sector or the banking sector, I truly believe that should be the primary focus or North Star for the banking sector, the goal set by the Prime Minister for 2047. That's one. For that, our credit to GDP ratio have to increase. Currently, we are one of the countries with the lowest ratio. I think we need to increase that credit to GDP ratio, at least 120, 130%, so that people who require credit is available. Now, the third pillar is the MSMEs. MSMEs, they are going to play a huge role in the country's development. MSMEs, we have to ensure they are productive and provide employment, and also ensure that they play an important role in the global export markets. For that, whatever we are actually supposed to do this. And the fourth important thing, how we converge the advantages of Fintech with the banking and the financial sector. We also need to harness the full potential of Fintechs, both to ensure financial inclusion goals, as well as to leverage the combined synergies for the more strengthened financial system.
I think you've articulated very clearly the priorities that the government has in the long term for the banking sector. Hopefully, many of those will happen in our lifetimes, not when we're gone. But since you raised the issue of MSMEs, an issue that is top of mind today in light of the tariff imposition by the US, the finance minister has also said that the government is working on putting together a package for exporters specifically. Any updates, sir, on when we're likely to see that fructify?
No, I think the finance minister, honorable finance minister mentioned, government is working on that. More or less, we have finalized the elements of the support that is required, at least from the financial sector side. And then I think we hope this is quickly finalized. And as soon as finalized, I think everybody will know that. And the government is fully aware of the difficulties currently being faced by exporters due to the tariffs of America. And then we wanted to support that. On that, the government is very clear.
The government is very clear. The finance minister did say that the exporters will not be left, in her words, high and dry. Secretary, you said that we need bigger banks. Do we also need more banks at this point in time? What is the government's view on that? And if we do, what kinds of banks do you believe we need today to service the needs and the requirements for the India of the future?
I think, one thing we all, those who are connected with the financial sector, I think we all believe that we need to have bigger banks, that's one. And a country of size, again I'm talking, we all, I think, this kind of population, this kind of trade growth potential, we also require more banks. On that, there is no doubt at all. The government is very clear that we also require more banks and also bigger banks. They are not contradictory, they all actually go together. Because we have about, let's say 300 to 350 million people. They have to be completely formalized to the financial system. And imagine that kind of number of people formalized, and then the kind of credit, the kind of the business, banking business that will be there. So the scope and area is huge for new banks also.
New banks also. So let me ask you a follow-up question, sir. The RBI's licensing policy, there hasn't been much change in the past decade as far as the licensing policy is concerned. Has there been any new, fresh dialogue with the RBI on that front?
I think we should have asked that question when the DG RBI was there.
But we can ask for the government's point of view, sir.
I think we'll leave that. I think we hope that RBI has, of course, laid out policy of granting new licenses and also transition of the small banks also. And we hope that now that maturity has come, I think RBI will take a call on that.
In light of the next phase of reforms that you spoke of, and one of the expectations which has of course been talked about for many, many years is whether the government will in fact look at bringing down its shareholding below 51%. You talked about meeting the SEBI minimum public float norms, but is there any active consideration at this point in time, sir, within the government to even consider the possibility of bringing the government's holding below 51%?
I think there is no, I don't think so. There is no proposal at all before the government to reduce that. They continue to be majority owned by the government because there is a public interest in government owning majority in the public sector banks. We are just not lending instruments, but we're also looking, the government is also doing a lot of credit to different neglected or under-serviced sectors, like education loans we provide, our KCC, Kisan credit cards we give, PM Swanidhi or PM Jivan Jyoti. These are all done because they are government banks. And we also, these are all not possible if they are private. So the government has an interest, in the interest of the national development, to continue to have majority shareholding. I think government stick to that.
What role do you see FDI playing in the banking sector? And do you believe that there is need for further liberalization as far as FDI in the banking sector specifically is concerned, sir?
No, I think, we know currently the existing limit we all know. I think we are actually thinking about it, but let's say in the public sector banks, whether it's possible or not, and the private sector, in any case, we have, that is available. We have not taken, the government has not taken a view on that.
Not taken a view at this point in time, but could that be up for consideration anytime soon?
The government can always consider. There is no, government is the government. The government can always think and come up with new ideas. Okay?
No, fair enough. Let's talk about the GST, sir, because one of the concerns that has been raised specifically is by the insurance sector. One aspect that the insurance companies are raising is that they had priced in the ITC benefits into their policies already. So can you at least not make a consideration for the ITC benefits to stay in the policies that already are in existence, as opposed to the policies that will now be given out? So the retrospective aspect of the ITC benefits being done away with, could that perhaps be addressed?
Now, see, look, let me tell you, I had a meeting with all the insurance industry, both public and private, in fact, yesterday itself, and all of them have welcomed the GST input, the zero GST on the individual insurance policies. And all of them have actually promised that they will pass on the benefits that likely to accrue due to GST. And the past policies are one thing, and the future policies are they are very clear, and we have not heard much concern on the input tax credit as far as the GST in the insurance sector is concerned. Okay.
What about the insurance amendment bill, sir? When do we see that being moved forward?
The government is very keen to get it done as quickly as possible. Insurance last bill. In fact, insurance bill actually includes both insurance, IRDA, as well as LIC, all three together. Government is very keen, and we hope to have this in the winter session.
In the winter session itself. On the insurance sector, sir, consolidation, a possibility there, at least as far as the non-life insurers are concerned. Is that something that is up for consideration?
I think when the government decides, I think we to inform, we will inform, okay? Allow the government to do our own homework, and then we will come back.
I'm sure the government is doing a lot of homework at this point in time. So there was a poll here that Lata just did with bankers on whether they expect a rate cut, and the unanimous view was that they don't expect a rate cut, at least in the upcoming policy. What's the North Block view?
No, I also think I don't speculate like bankers. They are entitled to speculate. But as Secretary in the Finance Ministry, I don't want to do that. I leave that to media and to Sherin Bond and all the participants.
Thank you for that. Mr. Nagaraju, you talked about profitability of banks, and it was a record year in FY25 for the banking sector specifically. Do you expect to be able to repeat that performance? What's the indication?
As far as whatever the winds I'm reading, the leaves, I think this year also we are going to have record profits. Public sector banking. The first quarter was very good results.
I don't know if you can hear the applause, sir, but there's a loud applause in the room the minute you said that.
Yeah. And, I keep hearing, I keep traveling, I keep hearing different cross-section of people. A large number of people actually are very happy that public sector banks are doing extremely well. And the culture we are actually changing. The one fundamental principle we are doing is our culture. The amount of trust public sector banks enjoy among the Indian public is enormous. And they're happy that now they are actually responsive, very responsive. And the system they have improved, digitization has done wonders for them. In any case, the top management is very, very good, highly caliber, skilled, and they are very, very good decision makers. So this quarter also I'm expecting good profits so that the country will be happy with the performance of the public sector banks.
Most certainly, sir. The country and the shareholders will certainly be happy if it is going to be a record year, as you point out. Let me end by asking you, Mr. Nagaraju, you talked about the message to bankers. You also talked about lending, banks lending more, and the credit to GDP ratio. What is the near-term target that you're perhaps working towards, or the near-term aspiration that you're working towards, sir, when you talk about growth and the bank's ability to be able to fuel that?
See, we feel that the credit has to last year's credit we want to do better than last year credit, okay, and especially the MSMEs we want to do it, and the agriculture sector we want to do well. Agriculture last year we did very well, and this year also we wanted to do well, And the other thing, which I think is not, because it's not a corporate, we want to do well in the PM Vidya Lakshmi. We want to provide scholarships to every student that is admitted into colleges. And we are very keen with we monitor. And then PM Vishwakarma, everybody, whoever has got skilling, if they want loan, we want to provide the loan to them. Because these are the critical, generally not highlighted or the prominently look at it. We want to provide that. So banks actually are our banks. Let me also use your channel to tell you, we have launched the financial inclusion campaign, saturation campaign from 1st of July. Now we'll be ending the 30th of September. In each village we are organizing. For the inactive accounts, PM Jandan accounts, we want to make active. And also all the PM schemes, PM Suraksha Bima Yojana, PM Jeevan Jyoti Bima Yojana. And also we want to provide the unclaimed deposits of the banks. We want to give the money back. And this campaign we have launched entire country. I want to, the participating by the media should actually participate, promote, ensure that the people take the benefit of this campaign.
We've always done that at CNBC TV18, sir, and we will continue to do that. Let me end. You've got a captive audience here of bankers who are watching you. One last message that you'd like to send to them?
No. I think one last message to my banker friends is that while we are doing well, I think we should not be complacent. The world is very dynamic nowadays. We should keep our ears to the ground and keep our eyes open and absorb it, and then accordingly we should respond to the situation.
Mr. Nagaraju, what an absolute pleasure, sir. Thank you so much for joining us and giving us a very clear path for India's banking sector and how the government intends to transform India's banking sector, not just in the near term, but with the target of what it aspires to put in place by 2047. Ladies and gentlemen, a big round of applause for the Financial Services Secretary, Mr. Nagaraju. Thank you so much, sir, for your time.
Thank you so much for inviting me. Thank you for so much. Okay?
Thank you, sir.
Thank you, Shireen, for that very candid, in place guarded, but yet optimistic chat that you had with Mr. Nagaraju. Now we are moving to a very special segment of our evening, and tonight we are honoring leaders who have guided us with their vision and outstanding contribution and have left a lasting impact on the banking industry. To present these honors, may I please invite on stage Shireen Bhan once again and Mr. Vishnu Dusad, Managing Director and Co-founder, Nucleus Software. Mr. Dusad. Welcome, sir. All right, the first honor this evening is for a leader whose career has been designed and defined by resilience, innovation, and relentless focus on growth. As the former CEO of Standard Chartered Bank in India, she has played an important role in strengthening the institution's presence and shaping its strategy in one of the world's most dynamic banking markets. Please put your hands together for Zareen Daruwala.
Zareen, it is such a pleasure for us to be able to honor you here at the CNBC TV18 Banking Transformation Summit. I've known Zareen for many, many years, and I have to say she's one of the nicest, the most kindest, gentlest people that I've had the privilege and the pleasure to have met in the course of the last 25 years. I want to take you back to your start, to your journey, Zareen. As you stand here on this stage today after having spent the last several decades in India's banking sector, what is that one defining memory that you have of your journey through the banking world?
I think, I can't say it's one, but I've witnessed several disruptions. I think first was demonetization, UPI in a positive way, then COVID. And I've, of course, seen the height of the NPAs also. So I've seen multiple events, and each one, I think, the banking sector has emerged much stronger from every storm. That was what I would say.
Well, you know, speaking about the future, and we just heard from the government on the government's aspiration as far as India's banking sector is concerned, from your vantage point of having experienced the banking sector for what it is and seen the many changes that you just spoke of, what do you believe we should expect in the next 10 to 15 years?
I think I was fortunate last week to have been called for the PSB Manthan in a panel discussion. And I think what I see today, the whole strength of the public sector banks and the kind of ROEs and ROAs that we are seeing, the public sector banks sort of displaying and, quarter on quarter, I think the whole public sector bank is a force by itself and re-energized in my view. And the whole transformation is really something that for the next 1 decade is here to stay. And we will see them really emerging very, very strong.
Well, that certainly is good to hear. But Zareen, you know, as a banker, and there are many bankers in this room, there are many bankers who are probably watching us online and on TV, who may be at the start of their career or in the middle of their careers. What was the one North Star that you sort of were guided by through the course of your career that you'd like to share with young bankers today?
I think integrity, to my mind. I think that's the currency of banking. And the trust that the customers and client place in you, to my mind, that is the first and foremost that everybody has to sort of imbibe. Because once you lose trust of a customer, it doesn't come back.
So what next for Zareen Daruwala?
That, Shireen, is something that is nothing is on the cards right now. But yeah, I plan to do something in the near future.
Well, I'm sure that there will be something of consequence and impact. Zareen Daruwala, what an absolute pleasure. Congratulations again, and thank you very much for all that you've done for the Indian banking sector. Appreciate you being here with us. Ladies and gentlemen, a big round of applause for Zareen.
Thank you so much for honoring me. It's really nice.
Thank you very much, Zareen. Thank you so much.
Next, we turn to a leader who has been at the forefront of building one of India's most respected financial institutions. Over the years at Kotak Mahindra Bank, she has played a defining role in expanding the retail and consumer banking franchise, driving digital adoption and deepening customer trust. We are super delighted to facilitate and felicitate this leader for her strong leadership and lasting contribution to India's banking sector. Let's have a huge round of applause for Shanti Ekambaram, Deputy Managing Director, Kotak Mahindra Bank.
Shanti, thank you again for being here with us, and thank you very much for giving us the pleasure of honoring you here this evening. As I said, Zareen is gentle and gentle, kind, and if I had to add one adjective to Shanti, it would be fun. She's one of the funnest persons that I've had the privilege and the pleasure of interviewing. And thank you once again for being here. But Shanti, as you look back at your own journey and the many twists and turns that it's taken, what would you say stand out as core memories for you?
First of all, Shireen, thank you very much. Thanks CNBC for honoring me, and I really feel good about it. And thank God you said fun and not funniest person. I just have to say thank God for that. Right. So, when I look back at my career, it's very interesting. I've had 39 years of working life. And I joined Kotak in 1991, almost end of 90, so almost 35 years. And that was the year Indian reforms started, if you remember. India's happened, banking sector's happened, Kotak has happened, and I've been in the midst of it all. So it's been an incredible journey. Just a small correction. I spent most of my life as a wholesale banker, right, which was corporate banking, investment banking, and 8 years in consumer and digital banking, which was one of the best experiences of my life. So I have seen India growth, ups, downs, banking, but banks continue as strong as ever. And I think when I heard the panel discussion earlier, and I heard Mr. Nagaraju, which was an outstanding interview, I think there's huge optimism in the air. We've never had banks so strong. We've never had balance sheets and profitability so strong. And I think with the resolute Prime Minister and Government of India, I'm very excited. But what stands out for me is the resilience of both India and the banking sector. Right through the ups and downs, the banking sector has been really resilient, and it's been wonderful.
You know, you talked about resilience, but let's talk about the other aspiration that Mr. Nagaraju said, that we want Indian banks to be in the top 10. How do we ensure that we get there? What do you believe the route is going to be?
Shireen, it's a function. See, banks are in the center of the economy, and banks are in the center of growth. So if $5 trillion by 30 and Viksit Bharat by 47 has to happen, there will be organic growth and there will be inorganic growth. So organic growth itself should drive some of this growth, and in that path, inorganic growth is inevitable, right? So we will see both as a path to growth for large banks.
Including perhaps Kotak being a consolidator as well. We don't know. It's happened in the past, but we don't know whether it will happen in the future. But let me end by asking you, Shanti, and we have the good fortune of having Zareen and you together with us here this evening. For young women who are looking at the banking opportunity as a career, you've spent 35 years in banking as a Zareen. What would you say to young women who are looking at this as a possible career option?
I'd say it's exciting. Be ready for a roller coaster ride, right? There'd be never a dull moment, but you have to come and be a part of it and excel. Aspire, excel, and join the ride.
Well, that's why you've got your sneakers on, is it? Join the run, Shanti Kamram.
Yeah, there's a little story behind it. I twisted my foot 2 years ago, and the doctor said 3 weeks you have to be in sports shoes. I loved it so much now, I only wear sports shoes with my sari.
Well, you're rocking the sari and the sports shoes. Shanti Kamram, a pleasure. Thank you so much. Ladies and gentlemen, a big round of applause. Thank you for being with us here this evening.
Thank you so much to both of you for doing the honors. And Shanti is not just rocking the banking world. I've just come back from hearing her at a community circle of women directors and how she's steering that as well, and inspiring so many women who are on boards, who aspire to be on boards, and a really inspiring and driven journey where we need more mentors and we need more women like her. And I just heard her a few hours back, and that was fantastic as well. Thank you. All right, moving on to our next discussion of the evening that shines a spotlight on the sector that has redefined how India saves, how it spends and borrows, Fintech. As customer expectations rise and regulatory frameworks tighten, how can Fintech players continue to innovate while ensuring long-term resilience? What role will partnerships with banks, AI-led innovation and digital infrastructure play in the long run in shaping this evolution? Now, these are the questions we will explore in our panel, which is called Fintech 3.0, Improvising Scale and Sustainability and Improving on the Frameworks that we already have. To moderate this session, we have CNBC-TV18's Ritu Singh, who's going to come on stage. Let me also welcome our panelists for today's second panel. Anubrata Biswas, MD and CEO, Airtel Payments Bank. Sohini Rajola, ED Growth, NPCI. Santosh Agrawal, CEO, Paisa Bazaar. Amrita Sirohia, co-founder, and Rishi Chabra, country manager, Visa. Delighted to have all of you here. Over to you, Ritu.
Thanks, Mugdha. Well, you know, India is really now being called the Fintech laboratory of the world, and a large part of the credit is to some of the people on the stage. Sohini, especially you, I mean, 20 billion UPI transactions a month, that's almost 8 lakh every second. I mean, no other country in the world is moving money at this scale, but the industry is also maturing, you know, whether that's fintech, wealth tech, insurance tech, payments. You know, now the question really is that you've blitz-scaled the industry. How can you make it profitable and how can you make it sustainable? So that is a question really that we want to tackle here on this panel. And for that, ladies and gentlemen, a very warm welcome and thank you so much for being here. But Sohini, let me start by asking you something that I've heard from quite a few fintech founders out there. You know, the real innovation when it comes to payments has not really come from one of the players in the industry. It's been done by NPCI. You know, do you at some point worry that the dominance that NPCI has in the payments market could be crowding out some of the private innovation? And some of them do say it behind closed doors.
That's a very interesting take, I would say, Ritu. On, so, you know, let's step back a little bit. And it was, I would say, extremely gratifying. I would almost feel a little smug to listen to the number of times UPI was mentioned just today, right? We are on a banking transformation summit, but, and UPI becomes the, I would say, the brand. It is NPCI which has brought UPI and a lot of other solutions. And yes, rightly, it has transformed the entire way India transacts. It is not just the world's largest real-time payment system, it is actually also the most inclusive real-time payment systems. There are many countries, more than 60, 65 countries that have real-time payment systems. We're not the first, but we've become the largest. And I don't think it has become, I think it would be a misnomer to say that that's because NPCI came out with some innovation. I think it is because of the way, it's everything when you look at right from the way the regulatory frameworks are. We came up with the framework, the technology, and the open standards. But all of the innovation has actually been built on top of that by banks, by fintechs, by third-party application providers. So we provide the railroad, but the real customer experience and the reason it goes from like nothing 9 years ago to more than 700 million transactions a day today is because of that layer that's been built on top of it.
Well, sometimes you worry if these rails are really going to take away the moat, you know, for some of these fintechs. But that aside, quickly before I move on to the others, what is the next big innovation? I think that's something we all really want to know from NPCI. You've done UPI, you've done FASTag, you've done Bharat bill payment systems and countless other things. What next do you think that will really change the way credit is seen in India?
I think that's a good segue, keeping in mind what we're talking about today, like the theme of this event itself, right? So when you look at any financial, the entire pyramid of financial services, yes, payments is at the foundation, right? But that payment itself and the fact that we've moved, like, you know, many years ago when I used to run cards and payments at a bank, I think there was this one classic fact that would be there in any presentation, which was only 3% of India's PCE is digital, rest everything is cash. I think that's been turned on its head, right? Today, majority of the transactions happen on digital. And what does that do? You talked about the moat. What that does is actually build the foundation for the next revolution, which is going to be the credit revolution. And we heard the DG speak about all of the frameworks, the regulations, everything else, the enabling structure that is coming around. I think what's going to happen, and innovation is not just an event, it's going to be built on top of UPI. You know, a few years ago when we launched credit cards on UPI, what that did to the ecosystem was, from only about 10 million odd point of sale terminals, today, on a monthly basis, credit cards get used at more than 25 million points of sale which are UPI enabled.
That is a huge jump from 10 million to 25 million points of sale in a matter of months.
Yes. So this is the 10 million points of sale which exist. Over and above that, so if you had only issued credit cards which can be used at point of sale in the traditional acceptance architecture or framework, that's it. You can issue one card, the same bank can issue 5 cards, 10 cards. but you're not really moving the needle. When we issued CC on credit card on UPI, that's been a huge, huge jump. And I think credit cards is, again, still there are about 111 million credit cards in this country. It's one form of credit, but I think we are going to be taking this to the next level of discoverability and delivery of credit. So when banks are able to, or fintechs are able to use all of those frameworks and the AI to decide that I can now offer credit, imagine it being discoverable at the point of sale, at a QR code, at the moment of truth for the customer whom you want to give responsible credit to.
Yeah.
And I think that's the direction we are headed.
Well, I'm very excited to hear all of this, but I want to ask Rishi at Visa what he makes of some of these innovations that NPCI is coming up with. With UPI, payments is virtually free. As a card company, how do you feel about your moat in the current environment? I know you're going to say you're not just plastic, you're a technology company, but tell us how zero UPI, credit on UPI, how has this impacted your business and its profitability?
I think that you've already spoken for me, but just on a very serious note, I think we applaud everything that NPCI and UPI have done. I think it's been fantastic. If you think of the digital inclusion, everything that Sohini spoke about, the touch points and so on and so forth has been great for India and Bharat, right? There's no two ways about that. I think as you speak about the moat that Visa has, I'll just take a step back, right? Visa's been around globally for 6 decades plus, right? In India, 4 decades and more, right? And there's a reason that Visa's been around. The security, the safety, the convenience that Visa provides to all cardholders and all its users globally stands true even today, right? Whether I use it for a point-of-sale purchase that Swati spoke about, or an online purchase, a cross-border transaction, or any kind of experiences and benefits that I want as a cardholder, Visa provides that today. So our belief is, A, we're very, very committed to being in India, extremely committed to doing more innovative stuff, whether that is in the agentic AI world, on the fraud detection side, making sure that everything we do is for safety, security of the consumer. If you think about tokenization and how we led the mandate with the RBI, who was very progressive about tokenization of card credentials online, today we have over 400 million card credentials tokenized online, right? So call it the bedrock or the infrastructure for all payments that happen online. We are very much working on that, leading the charge on that. So having said that, between consumer experiences, online experiences, point-of-sale experiences, fraud detection, preventing and making sure that everything the consumer touches and feels is safe and secure, is the moat that we believe in and we are here for.
So you don't think cards are going away anywhere? I mean, the penetration, of course, it remains very low, but is it being replaced by other forms of payment?
No. So that's a great question. You know, the last RBI data, if you look at, card payment grew 15% year on year, even as recently as May, June this year, right? So cards are not going anywhere. The number of plastics still exists in the market. We have more than 1 billion debit cards, over 100 million credit cards out there. The consumers have choices today. Consumers like you, me, everybody else have choices, which is fantastic. Maybe choices that we didn't have a decade ago. We have them now. And our needs are changing. How I want to spend online, how I want to spend at a physical retailer, how I want to spend internationally when I go travel for a concert. I'll just give you a small snippet of this. Coldplay was performing in Abu Dhabi earlier this year, right? Yeah. We saw a big spike in data and usage of Visa when people travel for concerts like that. Yeah. As recently as this weekend, we had a concert of Vishal Shekhar in Mumbai and Delhi. And we just saw the spend patterns of users when things like this happen, right? So consumers want the choice, want the convenience, and it's so amazing that everybody today has those choices. Till the time it's safe and secure, and it's a world of digital inclusion, going with financial literacy, I think the cards are not going away anywhere.
I think I'll pick up from safe and secure and ask Anubrata that, because virtually, you know, a few years back when 11 payment licenses were given to payment banks, you know, we saw very few survive this sort of payment business model because you can't lend, and credit is where the lenders make money. I want to understand what really got you to survive and how you've been able to get to this billion transactions, 100 million monthly users. That sounds very, you know, too good to be true. Just tell us what you've done differently in a model that is so constrained by regulation to survive and thrive.
I think let me first join the dots of what Sohini mentioned and what Rishi mentioned, and just let me point out something for the audience. if we just look at the data points which are being mentioned by Sohini and Rishi, we can just aggregate them into something called Digital India. 2000 to 2010, India doubled in terms of GDP. Digital India actually just doubled as well. 2010 to 2020, Digital India actually grew 8x. 2020 onwards, Digital India has actually grew 10x, which basically means Digital India's reached escape velocity, and payment banks are actually custom made to ride on the roads of Digital India, which has been built so well by Sohini and NPCI. And we are just actually now on the point of that escape velocity of scale. Let me make this point a little bit more sharper. As fintech companies are riding on the wave of scale, what happens on the consumer market is that second order needs start emerging. Initially in scale markets, consumers really start purchasing commodity products. Rishi mentioned 1 billion debit cards. It's really a commodity product. Everybody has a debit card. They just start using it for withdrawing cash from an ATM. Everybody has a bank account, so on and so forth.
So why do we need a payment bank?
And what happened from 22, 23 onwards is that people started getting very wary of the fact that digital payments have also made digital frauds very frictionless. And they started worrying about their main bank account getting really corrupted by the notion that their account could get overnight ripped away with the concept of a fraud. And they started opening a second bank account for digital payments.
Which is where you come in?
And willy-nilly, Airtel Payment Bank became India's #1 choice for a safe second account where they could open it digitally in 3 minutes. And we pivoted the notion, and we were perhaps the first bank to really challenge the concept of having a no-balance bank account at a fee, which was the best value, 200 rupee flat rate account, 50 rupees charged in a quarter, which if you think about it deeply is actually addressing squarely the notion of sustainability, because it really moves the concept of value towards an annuity business, recurring year on year, and really building scale and momentum as years go by. It's really demonstrated, therefore, in the payment banking model. And today the bank operates at a scale where you've got 100 million users generating 1 billion, as you mentioned, transactions of data points a month.
But, you know, how do you see this business model itself evolving now that you've established yourself as this safe second account people want to have to avoid digital frauds? What next? I mean, is this going to get you through the next 10 years, the next 20 years?
We have to root really this in the concept of where India is today. And our view is that in any fintech market, you are in the early point of scale maturing to having mature market leaders where each category has 3 to 4 significantly strong market leaders. We see that in payments where 90% of payments are happening outside banks, and you have 3 or 4 very strong payment players who are having large market shares. We believe that in India today there will be 3 to 4 large digital banks where people operate their banks through their mobile phones. Airtel Payments Bank today now is actually the 3rd largest bank in mobile banking usage in the country. It's State Bank of India, HDFC Bank, and Airtel Payment Bank in terms of mobile banking users in the country today. And therefore, if India were to think itself as a developed economy, as mentioned by the Secretary, just like UK has Revolut, Brazil has Nubank, Airtel Payments Bank can certainly claim to have the right to pave the way towards the next 100 million users, really charting their destiny to having their bank on their mobile phone.
Well, that is wonderful. I mean, I did not know that you're now the 3rd largest in terms of mobile-only banks. But Santosh, let me quickly come to you on the role you're playing as a marketplace, connecting consumers with banks, NBFCs. What's the trend you're seeing there? Because a lot of banks, these traditional companies, are also building now their own digital marketplace. So how do you avoid just being a lead generator? How are you evolving to become a more sustainable business?
See, we've pivoted from being just a lead generator today. We are an end-to-end fulfillment company. And I think the role of a marketplace is much more than just bringing a lot of products on your platform and comparing and telling you what's the best interest rate and go for the lowest interest rate. That's not what our job is. I think our job is, more importantly, for the consumer being able to match the right lender, for the consumer being able to tell that, look, if you, for example, you're running a small business and you want to come, you need credit, right? And if you come to our platform and if we tell you that, look, there are various ways of getting access to credit. If you were able to mortgage your car, the rate of interest will be lower. We can build a process which is digital in nature, where you can take an inspection of your car digitally, upload that, we pass it on to the lender, and the lender is able to give you a loan of a higher value and at a lower interest rate. That assistance to a consumer will always be of value. And if you're able to take a consumer in, see what is the best way of serving a consumer instead of looking at whether a customer wants a personal loan or a business loan or an auto loan. Instead of looking at a customer in that format, looking at a consumer as an individual and helping serve that need in the best possible manner, in the truest possible way. I think that model is of value, that model is a winning model, and that's the part that we are on. And I think for a model of that sort, where you're able to bring various products together on one platform from various institutions, you're able to match the right product, the right lender, the highest chance of approval, whether the customer, hitting multiple, bureau hits. And I would say that would definitely affect the customer's bureau score. So without going through that pain, being able to serve a consumer in the simplest fashion, I think that's the model that we are at.
All right. Amrita, thank you for waiting by so patiently. When we talk about technology, a lot of the use about democratizing credit, bringing financial inclusion. But you also deal with this wealth tech space, which is quite interesting. And I wanted to understand, how are you using technology to make sure that wealth is also not just, or wealth creation is not limited to the top 5% of the population?
Yeah, so I think I have seen that shift happen only in the last few years. I've always been in the wealth management space, and I can tell you that earlier, access to certain investment options or a family office or data, analytics on portfolio were all restricted to the rich. But today, and that's actually one of IND Money's moat, because how we are positioned is a super money app to manage your personal finances, where you get 360-degree view of your investments, you get full detail analytics into your portfolio, and again, managing money is something that people like the idea of having money, but managing money is difficult, right? So that's where we've built a lot of AI-enabled Mind, which is our inside chatbot. We've got a lot of analytics on the platform, which basically helps a user. So I think, and again, when you talk about wealth inclusion, products which were only accessible to the rich, where they were compounding, like a US stock investment. Today, anyone can invest into US stocks within seconds, open a demat in the US, start buying fractional stocks, which is again how we've really gone ahead and done wealth inclusion. Net worth as a concept was only used by the very rich. So if you see, but today, everyone is talking about net worth. Everybody's talking about retirement early. On IND, you can track your net worth within seconds, and that is one feature which is loved by our user. So those are the things how I think we've brought about wealth inclusion.
All right. I've been told we're running out of time, but Sohini, I have to ask you this question because SBI, HDFC Bank, Airtel, these are household names. What do you think will really shift the needle in the next, say, 5 to 10 years for fintechs to really become a household name? Everybody knows UPI, but how many people know a Super Money or a Cred or a Navi? Or what will it really take to make them household names in the next 5 to 10 years?
I think it's a journey. So I think there are lots of fintechs today which are, people would say UPI Karo. There was a time when people would also say stuff like Paytm Karo, right? So it's a journey. Because we are a country of 1.4 billion population, there's enough and more scope for many of these names, and not just the core payment apps. I think as they start giving more and more newer services, and they differentiate themselves, because there is enough and more on UPI as a base for any fintech or service provider to decide which is the segment of population they want to go after, what is the product they want to go after. If someone wants to make UPI Circle their core proposition and really go after that, I'm hoping each one of them, including Bheem, will be a household name. But it's a journey. It's not going to happen tomorrow morning.
Well, and a very important part of that journey and this infrastructure expansion is money going into the industry with zero MDR continuing. We regularly hear this grouse from players. Do you think, that will be an inhibiting factor?
I think what we need to focus on, Ritu, is that the UPI transaction and volume growth and of all the new features, that is going to continue to grow, and it is continuing to grow. We will continue to add not just new use cases, but I think there's been a lot of focus around security. There were discussion about the mule models. How do we enable credit discoverability? All of that, and whether it is wealth or insurance today, I think, while we were discussing earlier, there was this discussion about where is India spending, and we are talking about whether it is, credit companies, NBFCs enabling their collections, any of those use cases is going to continue to grow. So there are many ways of looking at where is the value being derived for the ecosystem. And I think the jury is still out on that. There is lots of interest in lots of new players who want to keep coming into the ecosystem. I think that is proof of the fact that there's a lot of opportunity here.
All right, on that optimistic note, ladies and gentlemen, thank you so much. There's a lot more we'd like to talk to you about, but we have to wrap this up. Thanks so much for candidly sharing your thoughts, and thank you all for being such a wonderful audience. Thank you.
Thank you for this wonderful panel, Ritu, and to all our panelists. Right, moving on. In a world where banking increasingly is becoming digital, the challenge is not just to innovate, but to do so securely and also at scale. Our next segment is a spotlight interview that takes us right to the heart of transformation agenda, building secure, scalable banking systems, and sharing his perspective on how financial institutions can leapfrog into a future-ready, intelligent ecosystem. We are joined by the visionary Vishnu Dusad, Managing Director and co-founder, Nucleus Software. And to take this special conversation forward, may I invite again Ritu Singh back on stage.
Thank you, Mugdha. Thank you, Mr. Dusad. Well, it's a pleasure to have you back here on stage with us at this third season of the Banking Transformation Summit. Let me start by asking two very used and abused words in banking, scalable and secure. Let's start by saying, sometimes do you think they can be at odds, and how well are banks really balancing this scalability and security at the same time?
Banking is all about trust. And if we do not secure, then there is no banking for that matter, no money business. So it is extremely important that we continue to provide a very strong foundation of security, and on top of that foundation we build the scale.
Yeah.
Which is what we have done, and we've been talking about these numbers the whole of this evening. It is a matter of immense pride for us as a nation that we are transacting 20 billion transactions, 2,000 crore transactions in a month.
Yeah.
And that has been possible because of these fundamentals that we have in a way taken care of. And there is, of course, there is some scope for us to improve it further.
All right, let's talk about security, because as the Deputy Governor was highlighting, the panelists after that, that has become a big concern as, fintechs are expanding, banks are expanding. Tell us how well banks, especially legacy banks and NBFCs, are using AI to counter this, smarter fraud that's emerging on the other side.
AI is just getting explored, I would say, and explored in a reasonable manner to identify the trends, the risky trends, not so risky trends, and then proactively go after those trends. So, for example, let's say we were talking about, the Deputy Governor was talking about how, some of the speakers were talking about how some frauds are happening in a specific manner.
It's become much easier to,
It has become much easier.
hack systems.
So it's only through artificial intelligence that you can identify those trends and, proactively go after those prospecting mule accounts, as we were looking at it. Someone creating a account as a TCS employee and then depositing the salary for 7 months and then going rogue. So those identifications, we will be able to look at the pattern of such an first such account and then scan the entire database to identify how many similar situations could be happening. And of course, all of them would not happen. But again, you will have an opportunity to proactively check out whether there is a possibility of, a fraud happening.
But, since you have an overview of this sector, I just wanted to understand to what extent is AI being used? The Deputy Governor again gave us some interesting statistics that 3/4 of the banks in their annual reports talk about adopting AI. But is it going beyond customer chatbots? To what extent is it being adopted?
I think, as at this moment in 2025, we have been, trying with, we have been experimenting with customer communication and so on. It is going to take some more time because of few challenges that are there. We all know about hallucinations and so on and so forth. So till the time those kind of challenges are addressed, we may not be able to use artificial intelligence to completely hand over the responsibility to the agents and do away with human beings.
Of course, the decision making has to be by humans, but the assistance is from AI. But when we're talking about expanding the system as well, millions of new people coming into the banking fold, hopefully into the formal financial system, what kind of infrastructure strengthening is required to be able to deal with that kind of capacity, and what kind of investments in technology are banks really making?
Okay. We've all heard about $3 trillion and by 2030 and those crazy numbers. 300 billion being committed by only one player. So I think the investments in artificial intelligence are going to be of very different kind. We all are aware how many data centers would be required and what sort of electricity they will consume and so on and so forth. So banks will have to be very careful about where do they want to experiment and what is the ROI that they would want to generate. And today, the way I look at it, and I could be excessively conservative about it, today I'm visualizing that it's going to take us in India 3 to 5 years before we can say that, okay, artificial intelligence has taken off in a substantial way. So investments are going to be substantial kind. Just the way we are going on cloud and then coming back on-premise, some of us. In a similar manner, we may experiment with AI on the large models and then we may decide to come back on a smaller scale.
So that's on the AI adoptability. What about the infrastructure readiness? As I said, what kind of changes or investments are required to make sure that banks are ready to cater to the next 100 million, 10 million that keep coming in year after year?
Okay, the way we will have to look at this is the new infrastructure will have to be very composable. And we have, a large number of banks have today infrastructure which is in some manner outdated. So banks will have to get into hollowing the score. Banks will have to get into, components which they would be able to put to use in the form of APIs and make sure that the latest technologies and the old data is put to use meaningfully.
Let me actually step back and ask you how you're helping banks. When we're talking about traditional legacy banks modernizing their systems, how can you at Nucleus help them do it? Just give us a glimpse of what it is you provide in services for banks.
We provide exactly the same thing that I've just talked about. Banks need to modernize. They need to modernize in a substantial way. And they need to get, cloud native. They need to have API-specific infrastructure. And that is what we provide. We have been investing in our software for, last decade and a half. And it is the latest architecture that we have invested in, and that is what we help banks do without any risk to their existing operations. We are able to help them modernize without any risk, thanks to the nearly 4 decades of experience that we have.
Well, if I were to ask you, though, to still list down 2 to 3 challenges that you see banks still coping with, when they're looking at modernizing their systems, what would those be?
I think these are essentially the kind of challenges that they need to address. If you are trying to replace the existing infrastructure, then it is going to be very, very risky. So you need to go step by step. You need to make sure that your current operations are not getting affected, and at the same time you are modernizing. So that is, and for that you need to go with a player who has done it, who has done it multiple times, and that's where a player like Nucleus Software comes in.
Well, could you list down maybe the top 2 to 3 technologies that you are most excited about that can bring about a meaningful change in the way we look at banking in India today?
Artificial intelligence is,
of course, no doubt,
is number one. I think the reason I'm particularly excited about it is the hyper-personalization that is required by us in Bharat would be possible only through artificial intelligence.
Okay.
We would be able to cater to very specific needs, almost at an individual level. Today, when a bank creates a product, it is for a segment. And segments are, they would service, they would help you, but I may have a situation where instead of equated monthly installment, I may be in a position to do equated daily installment.
EDIs.
EDI. Yeah. Instead of EMI, EDI. And that is where, things like technologies like artificial intelligence are going to help.
Okay.
And it will be possible for us to go to the, the bottom of the pyramid. We're talking about at least 300 million people who have not been serviced. Yeah. And that is where these technologies would be of immense value.
Well, on that note, Mr. Desai, thank you so much for sharing your thoughts with us. It's been a pleasure speaking with you. Thank you so much.
Thank you so much, Ritu.
Thank you.
Thank you. Thank you, Mr. Desai. Thank you, Ritu. And ladies and gentlemen, as we near the end of the evening, let's turn our focus on a sector that has become the backbone of credit delivery. to India's underserved markets, the NBFCs. And if India is to truly unlock the potential of its next billion consumers and entrepreneurs, credit must be accessible, affordable, and tailored to diverse needs. Now, what are the NBFCs doing? NBFCs, with their reach, agility, and customer-first approach, are uniquely positioned to bridge this gap from small-ticket personal loans to financing MSMEs and rural enterprises. Our last conversation of this evening is titled Credit for the Next Billion, and to moderate this session, I'd like to invite CNBC-TV18's Prashant Nair on stage. And joining Prashant are his panelists, Raul Rubello, MD and CEO, Mahindra Finance, Sudipta Roy, MD and CEO, L&T Finance, Asim Dhru, MD and CEO, SBFC, and Jairam Sridharan, MD, Piramal Finance. I noticed how that table was already buzzing with a lot of discussions. Now we might as well have them on stage. Prashant, all yours.
Thank you very much. Thank you very much for that. I must say this is the last panel, and I know that two of the gentlemen here out of the four are flying out and taking flights later tonight. So don't be surprised if somebody jumps off the stage and runs if this goes on for too long. But very, very kind of all of you to have made it. Really appreciate it. I was thinking, right, I mean, banks, we've done banks and we've done fintechs, and now we're doing NBFCs. Banks are like airlines, right? They're regulated, they are on schedule, they're large, right? Fintechs are like ride-sharing apps, if I may use the analogy, and correct me. You know, they're sleek and sexy, on-demand, etc., etc. What are NBFCs like? I thought railways.
Belgadi mat bolna bas.
NBFCs, I thought, are like railways. I mean, they go where others don't want to go, and they serve the underserved segments of the population. I mean, kudos to all of you. So, ladies and gentlemen, just a round of applause to the people here who do the heavy lifting and, of course, do the hard work as well. So, with that short preamble, let me get into it. And I want to start by asking you, Jairam, first up, NBFCs, and we were just discussing this on the table there, NBFCs don't have a liquidity problem. But looks like borrowers of NBFCs have a bit of a liquidity problem. Am I phrasing that correctly, and how would you respond?
Yeah, no, that's an interesting way to talk about it. First part of your statement, NBFCs don't have a liquidity problem, that is absolutely correct. The money is sloshing everywhere. Like we don't have a problem on the liability side. Almost none of us do. Like there is there is enough liquidity. There are all sorts of different sources of money, and it's not expensive. That's not a problem. But your point about the customers having a liquidity problem is absolutely correct too. What we are seeing is an environment in which the lowest end of the customer is not doing nearly as well as the average picture looks like. So you can look at India's average numbers on anything, and much of it looks like it's all trending upwards. But unfortunately, it doesn't seem to be evenly distributed. And at the lowest end, you find not as much growth, not as much sort of prosperity, not as much ability to lever themselves, etc., coming through. So I'll give you two examples, and then I'm sure my colleagues here have a lot more to say on this. So if you look, for example, at housing loans, you see that at the top end of the spectrum, things are looking pretty nice. I mean, there's enough growth, and you have all these news stories of this project was opened and the average ticket size is 10 crore and was sold off in 2 hours or whatever. Like you hear all these stories. But at the same time, you see at the lowest end, you see kind of the less than 20 lakh, less than 25 lakh rupee kind of housing loan market. It's degrowing. It has been degrowing for a year and a half now. So why is that happening? We know there is a housing problem in the country. People don't own homes. You would expect that a lot of people will be buying homes. Why is that not happening? It's not happening because the guy doesn't have enough money to put in his own contribution, right? So the low end is struggling. The second example I'd give you is, this was for individuals. The same is happening in companies. In companies, the largest companies are doing remarkably well in terms of borrowing. not necessarily in terms of growth and profitability, but certainly in terms of delevering themselves, balance sheet strength. They're doing remarkably well. But the smallest companies are really struggling in terms of balance sheet strength. They're not able to go anywhere. You look at risk metrics and delinquencies of the smallest companies in the country. Commercial loans for less than 1 crore, what used to be 3.5% credit risk a year and a half ago is now 5.25%, right? We all think that, oh, corporate lending today is like the safest lending. There is absolutely no risk at all. That is true on average. But if you break that average down and you look at the smallest guy, the smallest companies are struggling. They are not, so the big are doing really well, the small are struggling. That's my little headline for you.
Both companies and individuals as well, essentially, on the top end. I know a developer out of Gurgaon, Jairam, who started out as an affordable builder. He actually flipped to constructing super luxury projects.
There is nobody called an affordable builder anymore.
Yeah.
There's no such thing.
Yeah. Why do you think this is happening? Has something changed now? This is a continuation of the K-shaped recovery which started post-COVID.
I think it's a post-COVID K-shaped thing. I think we have not recovered from it. A lot of customers, see, you want to buy a house, the house costs 30 lakhs, you're going to get 80% sort of financing on that. You need to put together the rest. You need to put 6 lakhs, 7 lakhs of your own money. You need to have that level of, jama punji. गुल्लक में होना चाहिए ना उतना पैसा. अगर सारा पैसा यूज हो गया आपका कोविड के टाइम पे, बचा नहीं ज्यादा, तो अब आप बैठ गए हो, अब आराम से इकट्ठा करोगे, आपको लगेंगे 8-10 साल लगेंगे 6 लाख लाने में, तब तक आप वेट करो, उसके बाद घर खरीदोगे. ये हो रहा है, लोगों के पास पैसे नहीं है अपना कंट्रीब्यूशन डालने के लिए, सारा पैसा खर्च हो गया है कोविड में.
Mr. Roy, you want to come in? Would you echo those sort of sentiments?
No, I would echo those sentiments. And what has actually happened was that over last year, most lenders actually took their lending standards up, right? For example, if you see the current, and it's still continuing, if you see the current CIBIL data on a year-on-year basis, there's a 10% growth in credit demand, especially in the MSME sector, but the supply is 19% less. So there is a 30% jaw actually. So because your credit standards have, and it has happened because, there are two things that, one is fundamentals, the other is sentiment. And last year, because the regulator was tightening the credit flows a bit, that sentiment overall pervaded towards the lending ecosystem. And anyway, there were elevated delinquencies in the unsecured sector. And this year we are seeing a little bit of elevation of delinquency, which Jairam talked about almost close to 6% in below 1 crore, right, in SME. So overall, the sentiment, though fundamentals, the delinquencies actually, if you look at the retail credit system, has improved. But the sentiment of the lenders has not yet improved. So the supply is still less. So that is why, a large amount of the credit flow is struggling. And I do believe it's a adjustment period. The rate cuts have helped. And, as the delinquencies ease off, maybe in the next 1 or 2 quarters, things will start moving.
Sentiment of lender has not improved.
Sentiment of lenders have not improved.
But the sentiment remains soured because they are seeing risks.
There's a tail end of delinquency which we saw last year is still persisting. Though, it has been pretty stable for the last 2 quarters.
Right.
Fresh flows to that extent has not happened except in a little bit in the SME sector.
Yeah. Actually, it was on this very panel, I think, in 2023, right, Jairam? I think we talked about, and Jairam had flagged off the problem with personal loans, consumption loans, etc. And the RBI late 2023 had then raised risk weights for lending to NBFCs and then NBFC lending to borrowers as well. And then, of course, middle of 2024, you had the MFI issue. So, as you say, a lot of stuff has happened. But Asim, come in on this in terms of what you've heard and your inputs on this.
So, see, if you go back a little, in 2020, the total amount of loans to retail and to MSME used to be banking plus NBFC put together, used to be about 32 trillion rupees. Now, in between 2020 to 2025, this has doubled. It is now from 32 trillion, it's gone to 66 trillion. So there has been a massive increase in lending that has happened, pushing up.
Sorry, this is lending to?
To retail and MSME.
Okay. Yeah.
So between banks and NBFCs both put together. So there's been a massive increase in lending that has happened. And in that process, some customers always end up getting over-leveraged. So unfortunately, banking always moves from booms to bust cycles. So it is the nature of the beast. We were in a bust cycle in 20. We have moved towards a boom cycle. And when the party goes too high, the bill arrives.
So are we at the fag end of the party, or where are we?
No, so already since the last year, the party has already begun to unwound. It started with unsecured, it went into microfinance. The parties already begin to unwound now, and now it will stable. My guess is that it will now stabilize to its normal level of growth. The go-go days of credit are behind us.
And you think it'll, for the foreseeable future, without a new impulse, it stays like this, in your opinion?
Yeah, it'll flatten out to the normal, because see, also what happened is 2020 and all lenders cleaned up their P&L and balance sheets by washing it off. Now, after that, a new wave of lending began. And after 3 years of a wave beginning, usually that's when the costs come. So now what we are seeing is that NPA is not going up. It's normalization of what our normal NPA levels are. So we are just reaching the normal. It is not that it is increasing, but it is increasing from a very low base, which was artificial.
It may not be showing up in numbers in a big way, but one does hear that collections are getting harder, and maybe it will show. You're saying it will not show up in a big way in numbers anymore. I mean, from an industry point of view.
A few basis points here there, but I don't see that the stress. I mean, too much gets talked about in everything, So the reality is always somewhere in the middle. We are never as good as sometimes we appear to be, and we are never as bad as sometimes we appear to be. The truth is always in the middle.
I think that's well put. Rahul, your thoughts in terms of what you heard so far from the other three and your inputs on this question.
It seemed a little glum till now. I won't change the mood completely, but let me just echo some of what we've seen, which is very true. You've seen that the household leverage has been high. We've seen that liquidity has been a strain. But also what's important is the lending that we do to support these assets. The asset prices have really gone up, right? Take, for example, just vehicles. The cost of an entry-level vehicle has also shot up significantly. The cost of even the affordable housing or whatever that you're lending for has gone up disproportionately higher, which has led to lenders being extremely cautious. I was just looking at a figure of what TransUnion put out. In June 23, the contribution of NTC for all lenders was 17%. That's down to 7 now. So that's the kind of contraction that's happened because the qualification of customers who are inquiring itself and their income levels don't support the kind of debt that they're signing up for. So it has been a bit grim for quite some time, but there's always light at the end of the tunnel. We do think that what probably the GST will do in terms of freeing up some of the household expenses and putting more disposable income could possibly usher in some change.
Jairam, are you hopeful? We've had tax cuts, rate cuts, GST cut now. You think it'll all show up and there is this, I don't know whether a pent-up kind of thing is the right way to put it, but do you think it'll show up in a bigger way next year?
Yeah, I think it's been a bit surprising that it hasn't moved up already because there have been enough stimulus actions that have been taken. But this GST thing, I agree with Rahul. Like the GST thing is looking promising, right? My mom and dad have had the same TV for 10 years, right? They wrote a WhatsApp message to our family group thingy where my dad is saying, "सोचता हूँ बड़ा TV ले लेता हूँ, GST कट गया है." मैं बोला, "पापा इतने साल से आप बैठे हुए हो, ये 10% का GST कट से आप TV खरीद रहे हो." तो I think there is something there in this GST thing. I know all of us are kind of a little bit frustrated that, because it was launched it was announced, but there was kind of a lag. So all consumption has actually been suppressed in this interim. But literally my dad's watching the calendar and he's like, 23 तारीख को जाके ले लूँगा TV. So I'm guessing there are a bunch of people sitting out there who's going to come in well, maybe this is hope, not foresight. I don't know. But it does feel like GST is a bit different than what we have seen, and the psychological impact of it does seem good. So I'm actually pretty hopeful that there will be at least a kicker. Whether it persists into a more kind of healthy consumption pattern in the medium run, that's to be seen. But in sectors like auto, etc., which have gone through so much struggle in the recent past, any such boost is really good news.
Autos is one, but what other segments? And when we say this gives a consumption boost, but wasn't consumption loans the problem to begin with? Or rather loans for consumption. I mean,
I think talking about all credit as bad is not appropriate. Like, and I think, yeah, some credit went bad or some credit gave risk. Well, let me step back. Let me say something which is kind of where I'll try and put this in perspective. If you look at a 50-year period and you look at credit growth in India versus nominal credit growth, right? We all have a little bit of an intuition which says, yeah, credit grows at about 1.25x nominal credit growth, nominal GDP growth, right? So that's kind of some intuition we have. You look though at the last 10 years. In the last 10 years, credit growth has been equal to nominal GDP growth. We have not seen that multiplier. So the GDP growth that we have seen in the last 10 years is not fueled by credit to Indian consumers and companies. It is not fueled by that. Yes, we should all worry at all times as lenders about over leveraging, but there comes a point where you also have to worry about the opposite, which is under leveraging, which is for a country to continue to grow at the kind of pace that if India needs to steadily grow at 8% plus, can you genuinely achieve that with a 4% inflation rate without at least a 15% credit growth? I don't think so. I don't think we can. And where we are running today, which is kind of that very high single digits or 10 to 10.25% type GDP credit growth, is just not enough to drive an 8% credit growth. So we should all feel happier if credit growth happens, even if some of us will end up taking losses to fund that credit growth. It will still be good for the country.
Where will, Jairam, just one quick thing, where will this show up in a significant way? Which segment?
I think cars is where you should look first. Cars is the canary in the coal mine. It is where demand picks up first. And some of the other urban lending that tends to happen more unsecured than secured. You should see it. If you see the government following this up with, let's say, a larger scheme for PMAY or something like that, you might see it in housing as well. But I would look for cars and unsecured lending.
Mr. Roy, same question.
See, I consider there are three types of taxes, obviously. One is direct taxes, indirect taxes, and last is inflation. Now, if you see, government has given a direct tax cut at the beginning, now there's a GST cut, and inflation is also moderating. So in a way, our house economist estimates that all this will add to about 5 lakh crore of consumption in boost in the country in the remaining part of the year. Now, considering 20% LTV and the remaining is financed, we are looking at a 4 lakh crore of credit growth or a credit infusion. That's simple maths. But I do believe that the demand will be far more palpable in the wheel segment, primarily in tractors, two-wheelers and auto, and some part in consumer durables. So these are the segments in which you will see a good amount of demand push. And I agree with actually Jairam's comments on credit to GDP growth. Ideally for a well-functioning economy, credit to GDP growth should be, nominal GDP growth should be 1.5 times. Right? And if you look at the growth that we have seen, it's been erratic. Barring 1 year post-COVID where we saw a good amount of growth, it's been quite erratic. And if we are talking about a Viksit Bharat by 2047 and a $35 trillion economy, then your size of credit, if you say 150% of GDP growth, 150% of credit to GDP is the right amount to be, you are supposed looking at roughly about a $55 to $60 trillion credit economy, right? And right now we are nothing, right? So we are about $4 trillion. So the growth has to be huge. And unless the credit growth actually follows that formula of 1.5 times nominal GDP growth, will not get there, because ultimately it's credit to a large extent that fuels growth. Something can be organic, but credit is finally the ultimate catalyst.
No, absolutely. Asim?
What is happening probably is that the cut in GST and the cut in taxes is not yet reflecting on the ground, primarily because that Indians turned investors from savers. And last year, $90 billion has gone by DIIs into the secondary market. The market has given absolutely zero return all of last year. So suddenly, I'm not feeling rich anymore as an investor, because you also spend when you feel rich. If I'm not feeling richer, I'm not going to spend right now. So some of the incremental spend that was coming from capital market gains has not played out well this year. That also is a little bit of a dampener. So these are cycles, and it takes a little while. The tax cut, like for example, when the income tax cut happened, the benefit of that is back-ended. GST benefit is yet to come. We just get excited, with an announcement and expect an immediate impact on the ground. Doesn't work that way. Will there be an impact in the second half? Certainly. But then there are balancing factors as well. I mean, the floods and the overall situation in North India in parts is concerning, and that will have a likely effect on agriculture and inflation as well. So on the level, will the second half be better than first half? Definitely yes.
But in a bigger way, it should show up next calendar year, next financial year.
So see, when all the tailwinds are with you, then the benefit is amplified.
Yeah.
Right now, there are as many tailwinds as there are headwinds.
Yeah.
You know, so we are kind of not moving at the pace at which we would like to.
Yeah. You're absolutely right. Markets have been flat for about, 14 months now, 13, 14 months now, so that wealth effect is not there. Maybe we need a new wealth effect. Gold is, and I'll get to gold in just a bit. Rahul, your thoughts on this in terms of whether this will show up in a bigger way? All what the government and the RBI have done.
Yeah, and just the categories of growth which might see a step up. We're already seeing from a YOY basis, the mortgage business is doing reasonably well. What's really been flat is the unsecured business and the wheels business. I think the biggest beneficiary, as what Jairam said, will see a big step up, whether it's two-wheelers, three-wheelers, passenger vehicles, tractors. Definitely we will see a step up. I'm not so sure about unsecured, whether it is PL or business loans, just from the fact that when you look at the vintage curves, if even the recent sourcing doesn't instill too much confidence in lenders to have a lot of enthusiasm to go down that path. But otherwise, I think lenders will take courage from the sectors I talked about.
And autos is a big part of Mahindra, right? I mean, two-wheelers and passenger vehicles, etc. I mean,
couldn't be a better time to be in the auto lending business. Yeah.
Okay. I want to just throw it to all of you. And so there are two things. One is the entire MFI issue, which MFI loan problem started sometime in April of 2024. 7-8 crore borrowers, so impacting a large number of households. Is that an issue which also is one of the headwinds, as you say, as you put it, because there are second derivative, third derivative kind of impacts. They are all players in different ways in different segments. I mean, these borrowers. Do you think that, as it starts to get fixed, will also will from a headwind it becomes a bit of a tailwind, or at least stops being a headwind? I don't know. Who wants to take it?
See, on MFI, the first thing is that obviously if you look at what was the outstanding last year, March, it was about 4.3 lakh crores. Their outstanding as of today is about 3.3 lakh crores, so 3.4 lakh crores. So almost 1 lakh crore has got shaved off from the MFI outstanding. So obviously borrowers in the villages, especially village borrowers, have got squeezed. And MFI has adjacencies to a couple of things. MFI has adjacencies to like wheels product like tractors, and MFI has adjacencies, large adjacencies to two-wheeler, right? So obviously, as the MFI crisis started, you could see a little uptick in two-wheeler delinquencies, especially in the rural areas, as well as in semi-urban. Also, you saw one more thing, that MFI borrowers being denied credit were moving to gold. So in a way, gold got the positive impact of the squeeze in the MFI sector, and adjacencies like tractors and two-wheelers got the negative squeeze. And obviously, what has happened is that because many of the smaller MFI companies have got a bit hurt and they are beefing the capital base as well as the liabilities originations, there is a little bit of vacuum in the market as well. So the good players are seeing traction over the last 2 months or last 3 months, and collections efficiencies have been stabilizing. So I do believe that the cycle is at the fag end of bin stabilization, and MFIN actually worked really well. They stepped in at the right time, they made the guardrails, they made everyone follow the guardrails. So the sector actually stabilized much, much faster. So hopeful of a good rebound, but yes, some of those adjacencies still remain. It's still paining some of the lenders. But I guess in another 3 to 4 months, it will move towards resolution.
You're saying that what the big jump we've seen in gold loans, and that's a segment which has done phenomenally well, is because of this, the same MFI borrower set moving here.
Yeah. So they got the tailwind from the MFI crisis because, gold is last resort, right?
Yeah.
And the fact is that even if your bureau is not good, you take gold, you'll still get a credit facility.
Yeah.
But tonnage on gold has remained constant. It has not increased, right?
Yeah.
Which means that top-ups, because RBI has increased the LTV, top-ups have been more driving the volume.
So the big jump in gold loans, and some put it, is not some special new crisis which is developing. No. It is just this. It is this move from MFI. Jeremy, you wanted to add something?
Yeah, see, this cycle in MFI is unique. In many ways, this is the MFI sector growing up. It's the first big cycle in the post-deregulation era after RBI kind of changed all their rules and made the sector kind of let the sector go in 2022. This is the kid going to college for the first time and kind of having way too many drinks and having a massive hangover. So it's a coming of age thing for the sector, and I think the sector has reacted really well. You have to we are in so many different businesses. The folks on the panel here, we are in so many different lending businesses. I bet you there is no business like MFI where the entire industry makes up its mind that, okay, this stuff is not good. I'm going to go pivot, go start doing that stuff. Never happens in any other industry. It happens in MFI, right? Try convincing 5 mortgage lenders to kind of align their credit policies. You'll be here all night, right? You'll never get them to align. But, but MFIN gets all 110 microfinance lenders to a table and everybody's like, yeah, sure, where can I sign? Right? It's kind of crazy. So the sector has reacted really well. I agree with the point that Sudipta is making that kind of new business, particularly post Diwali of last year, new business that has been booked is looking actually very, very good in the sector. And this is a sector in which old business runs off very quickly and new business starts to dominate. So I think certainly if I were a betting man, I would say we are at the beginning of an MFI cycle, not at the end of the previous one.
MFI cycle up. I mean,
yes, upwards.
Yeah, upcycle.
Yeah, an upcycle. Sorry, I should have been clearer.
One thing people have to understood right now that the safe speed for this sector is between 15 to 20% growth, not the 30% growth that we saw previous quarter.
And I think we'll get to it now. Gentlemen, we're kind of sort of running out of time. Technology and AI, I think we discussed this last time.
You should ask Asim this question. He has lots of views on this.
So Asim, I want to start with you. I mean,
Asim and I were joking when we were down there that every time people mention AI, we are going to take a shot, right? And Asim was like, we're going to be punch drunk by the time we get to the podium. So Asim, here you go.
No, but
this is your chance.
The pace of technology change, etc., has been phenomenal, right? But has the in terms of how you use all these technologies, I'm sure that the adoption is slower or as fast?
On a lighter note, more than artificial intelligence, we are relying on natural stupidity. But the way to look at it is that the high net interest margin era is behind us. Banks have now, that whole CASA game is now behind us. This is a structural shift, it's never going to come back. Which basically means that banks will have to learn to operate at lower operating cost from where they are right now. They'll have to almost halve their OPEX. Gone are the days where you could live with a 45% cost to income ratio. You won't be able to now if you want to be profitable. What is applicable for banks is also applicable for NBFCs. So for us too, efficiency is the only way we are going to survive this game because margins are going to be under pressure. That is a reality. At the moment, margins are expanding. It's a nice cycle for NBFC right now. It's good to be an NBFC than be a bank right now. But that's temporary. That will change. Ultimately, all this technology, what it is doing in the end is that if it is able to help you either acquire more, speeden up the process, or do it at a lesser cost, that is where the impact will come. Now, are all these technologies impacting this? Yes. But still, we are right now, we are getting away with a lot of inefficiency because we have margins. Going forward, those margins are going to come under pressure and we will have to be forced to become efficient. So will we all have to migrate towards these technologies and adapt it and embrace it? There's no choice.
And it's already happening. Gentlemen, any of you want to?
I give a 30-second stat, right? Yeah. And as a live stat, about 2 weeks back on a holiday, we made 10,000 AI bot calls for collections in 6 languages. My average success rate of collection was 50%. My average call center collection rate is 63%. My average cost of collection on a human call center is $290. My average cost of collection on the AI bot is $16.
1.6.
1.6.
1.6 versus 290. Wow.
So see, the fact is that, whether you want to adopt or not adopt, the system will force you to adopt. Otherwise, you will become non-competitive. AI is very, very successful for us for underwriting people with thin files. People with NTC and thin files are one of the toughest problems.
Sorry, people with?
New to credit or thin files are one of the toughest problems to underwrite. So typically you end up extending lower credit. But AI helped us to now we call it undiscovered prime. Helped us to unlock that. And that has been really brilliant for our two-wheeler portfolio. Average two-wheeler portfolio bounce for us, before we adopted it, used to be 20%. Our average two-wheeler portfolio bounce on this underwritten portfolio is 7%. This is a 13% job. So AI used effectively is really, really effective.
Jeremy, you want to?
See, what we have found so far, there are 4 areas where I've found AI to be powerful enough to actually show up in your numbers. First is risk management and underwriting. The point that Shudipta mentioned, absolutely, your underwriters are vastly kind of more empowered to take the right decisions. Your collections guys know exactly which accounts to call, etc. No doubt about it. So credit risk and underwriting is number 1. Number 2 is software development. So all your software developers, like 30-40% of all coding happens as vibe coding now. Like engineers can keep quitting and you can keep not hiring. Like that's a problem for like the employment problem is for someone else to solve. So software development is the other area where we're seeing massive benefits. The third big area that we are seeing is outbound calling or inbound calling. So customer service, collections, anywhere where calling happens, converting that to bots, even interviewing like HR at scale, being able to do it or using AI bots, very straightforward, lots of different activity happening there. That's number 3. And number 4 is marketing, creating content and being able to do it at scale. Those are the 4 big areas where we have been able to do massive levels of improvement using AI.
Rahul, you want to add something to this?
I think it's all covered.
It's done? Covered? Okay, I think time's up, ladies and gentlemen. I'm going to just, I had an agreement with Asim that we'll close with, for those of you who don't know, Asim is a poet himself, if I can say. He's a connoisseur of Urdu poetry, and so they're asking me to ask you to sing. I'll not do that. But I think you have something that you wanted to share with us.
On this occasion, to quote Iqbal out of context, always there is a question, that what happens to NBFCs? But there's always a question at all forums. For 30 years, this question comes. So I'm quoting Iqbal out of context here, where he says, "Kuch baat to hogi hum mein ki mitti nahi hasti hamari. Sadiyon se raha hai dushman daure jahan hamara."
Jairam, one from you?
नहीं यार
कुछ तो
क्या बोलूं यार अभी नहीं रहने दे भाई.
Gentlemen,
I'm reminded, before I came on here, somebody WhatsApped me and reminded me, you're walking a very thin line. So I was like, okay, I'll try to stay away from the line. So don't tempt me.
Thank you very much. All of you. Jairam, you have a flight to catch. I think you're leaving to the airport straight from here. Thank you very much, Mr. Roy. Really appreciate it. Asim, as always, appreciate it. Rahul, thank you very much. Ladies and gentlemen, thank you.
Thank you, gentlemen. Thank you, Prashant. Well, with that, ladies and gentlemen, we are wrapping the 3rd edition of Nucleus Software presents CNBC-TV18 Banking Transformation Summit. I'd like to extend our heartfelt thanks to our presenting partner, Nucleus Software, for powering this platform and making today's dialogue possible. Thank you to all our speakers, panelists, and to all of you for being such a wonderful audience. Thank you.